Good morning, everyone. It's 9 a.m. here in New York City and in Washington, D.C., where Rochelle Akufo is. I'm Brad Smith, and here are the three things that you need to know as you start your morning. It's been a rocky August, but winds are shifting into the month's end. The consumer story still front and center. HP, the latest to bear the brunt of the slowdown. The PC and printer giants shares slide on mixed results and a cautious outlook. The economic data is telling its own story, as this morning's ADP report follows yesterday's JOLTS release, showing a slowing jobs opening market as well. And Hurricane Idalia slams into Florida as a Category 3 storm. It made landfall just before 8 a.m. Eastern Time in the Big Bend region, bringing with it winds of 125 miles per hour. Dozens of counties are under a state of emergency as a storm surge of up to 16 feet is expected in some parts of the state. President Biden says he's been in constant contact with Florida Governor Ron DeSantis. And Bitcoin's big win. We speak with Grayscale CEO Michael Sonnenschein after a federal appeals court ruled the SEC must review the firm's bid to convert its Bitcoin trust into an ETF. The decision effectively paves the way for the first spot Bitcoin ETF and more widely for crypto assets to cement their status as part of mainstream finance.
It seems that bad news is good news for now with the markets. The S&P 500 had its best day since June on Tuesday. That's after the July JOLTS report showed job openings edging lower and consumer confidence lost its summer spike, dropping way below expectations. And this morning, we can see futures climbing on news from ADP that private payrolls slowed their growth in August, adding 177,000 jobs compared to 371,000 in July. Now, as investors anticipate further rate hikes later this year, any sign of the economy softening is a breath of fresh air for markets. Joining us now with some stocks he's watching in this volatile market is Chris Versace, Tematica Research Chief Investment Officer. Good to see you, Chris. So in this environment, let's start off with some of your top stock picks that you're looking at the moment.
So, when we try to capitalize on the evolving landscape, really layering into thematics as we do that. But, one of the pervasive areas that we tend to see just gaining traction is going to be the area of cybersecurity. Over at the Action Alerts Plus portfolio that I manage for the street, we have broad-based exposure to that in the Cyber CIBR ETF. And, we like that because it not only gives us broad-based exposure, like I said, so we're not relying on any one particular cybersecurity company. We like that because, again, of the evolving nature of cybersecurity threats, whether it's, increasingly an IoT or some other attack vector. The way we think about it is as we continue to move deeper into the digital world, hackers become increasingly creative, forcing companies to once again re-protect, if you will, their crown jewels. So we like that, but we're also seeing other signs that are emerging that kind of point to an improving smartphone market, particularly outside the Android ecosystem. In that environment, yes, we do like Apple, but we're becoming increasingly positive on Qualcomm. We also like a company called Universal Display that is seeing and benefiting from the adoption of organic light emitting diode displays, not just in smartphones, but increasingly in tablets, and in other markets.
Chris, in the type of environment that we are in and kind of naming some of the economic data that's come out that the Fed, sure, at their next meeting might consider, but at the same time, a lot of people not really expecting them to really make a decision one way or the other firmly until November meeting. And so kind of waiting and seeing. In this wait and see period, where should investors be most apt to kind of pick at a few names where you've kind of got the Fed on the sidelines, at least at this upcoming meeting?
Well, Brad, I think you used the right word, which is pick. And I say that because it's very difficult to go kind of like, all in or all out, because we're just not really sure what the data is going to bring. And as Rochelle had mentioned, we saw some nice favorable data that says, yes, the Fed's efforts are bearing fruit. The ADP report showed, slower job growth month over month. It also, if you dig into it, showed better wage gains. And by that, I mean slower wage gains year over year in August compared to not only July, but earlier this year as well. The JOLTS report you referenced. But let's just understand, we have a lot more data that we're going to get, not only before the September meeting, but before the November meeting. My thinking here is, at least in the very near term, we've got the July PCE that will drop, or be reported, I should say, tomorrow on Thursday. We've got the employment report. We've got data from ISM, S&P Global, both for manufacturing and services. And we still have the July data August data coming for CPI, PPI, again, all before the Fed September meeting. And my thinking on this is the market is going to be very volatile, kind of trading, right, on the most recent data point that it gets, because we're trying to assemble all these puzzle pieces together to figure out what is the Fed likely to do. So my advice against that backdrop, as you kind of alluded to, Brad, is have your shopping list. I rattled off some of the things that we own over at Action Alerts Plus, some of the ones that we're looking at as well. And we're just going to slowly build our positions using pullbacks, hopefully to improve our cost basis.
And Chris, of course, we've been keeping an eye on the state of the consumer as well. And as they continue to hear things like, the job market, not quite as tight as people had assumed before, talk of recession, not sure what the Fed is going to do. For some of these companies that really bank on value plays, like your Walmarts, of course, I saw your McDonald's on there as well. What should we be thinking in terms of the stocks to watch as far as consumer behavior?
So, if you look against the backdrop of where consumer credit card balances are, the higher incremental cost that we're seeing to service that debt, ongoing inflation, yes, we're seeing improvement, but make no mistake, all the data that we've seen thus far doesn't point to deflation. It just says prices aren't rising as much as they were. We took a look at consumers that are undersaved, and a variety of other factors. And then we layer on top of that the return of student debt payments come October. So when we look at, guidance out of Target that sees negative comp sales, for the current quarter and for the holiday shopping season, Best Buy, they also see negative comp sales for the current quarter, possibly negative for the holiday shopping season, possibly slightly positive. It has to give you a pause about the state of the consumer. So, some of the names that you just mentioned, Rochelle, Walmart, I'll throw in Costco, McDonald's. Where are consumers going to go to either save on what they're spending, or, as I like to say, stretch the disposable dollars that they do have? And, I've been a bull on Costco, remain very favorably inclined toward Costco. And that's one that, if we do see some volatility in the market, the shares pull back, that is one closer to 500 that I think folks can really step into.
Delinquencies, though, in credit cards have been one of the kind of continuous threads or common denominators that we've heard. Is there anything that we can extrapolate about that from retailers who are saying that there's clearly more balances that are adding up among their own card users, and apply that to the broader kind of consumer market or consumer environment right now?
Well, I mean, let's just think about what that says, Brad, right? If those balances are moving higher, the interest rates are high, it means that the longer they wait to pay them down in force, right? Not just the minimum payment, but the longer they stretch them out, the more interest is going to accrue. The overall higher amount they're going to have to pay. That money has to come from somewhere, right? So it's another point of pressure on disposable income. So it does concern me. And the great thing, I guess you could say, is that most of the major banks release their delinquency rates, once a month. So we can start to track that, especially as we go into the September to December time of the year. And again, it's really going to be probably that October, November delinquency data that we really want to pay attention to, because again, early October is when those student debt payments resume.
And Chris, obviously, we're coming to the tail end of the earnings season right now. But as you look ahead, what are some of the themes you think are going to dominate the next earnings season, given some of these weaknesses that we're seeing, and given that the Fed really didn't mention anything about rate cuts coming up anytime soon, and some of these recession fears creeping in for next year?
So, we are just kind of coming to the end of this. We've got a straggler of retailers and a couple of other companies. But actually, before we get to the September quarter earnings season, we're going to have this mini wave of investor conferences. And I'm really curious to hear what companies have to say, because we'll be, 2/3 of the way, maybe a little bit more into the current quarter. So what they have to say about, what they're seeing in terms of, foot traffic, sales? What is the dollar doing? Does the dollar has rebounded? What are they seeing in terms of international demand? All of these things are going to start to really kind of come through. And I would also toss out another key thing that I'll be watching even before that September quarter earnings season is what is the August revenue report from Taiwan Semiconductor. And I throw that out there because, we've seen very, very good reinforcing data of late for data center, but we also want to confirm that smartphone ramp is happening. But as we think about that data and what it says will possibly impact, some of the high flyers of this year, good or bad, whether it's, going to be Apple or NVIDIA, for example.
All right, Chris, stay with us. We've got a few more things to discuss here this morning. Of course, if there is one lesson that we can take away from second quarter earnings so far, it's that CEOs are still bullish on AI. Need proof? Well, this quarter, almost 40% of companies in the blue chip S&P 500 index have mentioned AI in their earnings calls. That's according to data from AlphaSense. Now, enterprise software giant Salesforce will report its Q2 results after the bell today, and chipmaker Broadcom set to report its quarterly earnings on Thursday. The street will be keeping a close eye and watch on whether or not these companies are benefiting from their AI initiatives. Will their big AI bets pay off? Well, let's put that question to Chris Versace, Tematica Research Chief Investment Officer, still here with us. And I suppose as part of this kind of like show me phase of the AI story, it's really going to come down to where we're seeing it in the financials, where this is actually starting to trickle through to some of their margins. And is there anywhere that we've seen that just yet?
So that's kind of a big question, Brad. So let's just think about, AI and the disruptive, promise that it has. I've likened this a lot to what we saw back in, 1999 to 2001 with the internet. And I say that because, if you think about what we use the internet for today, whether, as I'm communicating with you guys today through Zoom, whether we're paying bills, streaming movies, downloading books, whatever it is. We didn't really have a firm grasp of what that was at the start of the internet age. And I would argue that we're pretty much like that today. Are we starting to see some, benefits relating to AI in advertising, in productivity? Yes, we are. But I would argue that, we have a lot more to go. My fear is that despite the very good guidance that NVIDIA gave, that we just see too many companies, mentioning wherever they can the promise of AI and the disruptive power on its business. Yet we have other companies like Microsoft are saying like, look, we see the promise, but we need to invest to further deliver on the benefits of AI to our customers, our user base. So I think it's going to be kind of, bouncy. I hate to say that because it's rather nebulous, Brad, but I think we're going to have more concrete, let me put it this way, the more concrete examples we have of where AI is showing real benefits to companies, I think the more real the AI revolution becomes in the near term. Longer term, I do expect it to be rather disruptive.
And it is tough to avoid this FOMO that you're seeing. Obviously, a lot of companies just sort of throwing generative AI out there without really, as you're saying, having proper use cases. But especially as you look at NVIDIA and how expensive it is, a lot of hedge funds were hesitant to jump on that bandwagon. Is it too late? Have they already missed the boat given where NVIDIA's price action is at now?
So I'll say this, and this is a person who, I'll call it out, right? We missed the move in NVIDIA. We have had and still have a very great move in the shares of Marvell Technology, another company that's going to benefit from AI. But as it relates to NVIDIA, the easy money has been made, and I think they need to show a lot more progress on what they're doing and really start to deliver on that guidance because it was clearly head and shoulders of what anybody was expecting. The only thing that gives me a little pause with their guidance is if it is so good, why did they come out and announce a $25 billion share repurchase? And the counter to that is, wow, they're going to be spitting off so much cash that they can afford to do that. I get it, but I think just given the run in the shares, there's probably other areas that investors can look into that will benefit from AI.
And as we're waiting, of course, for the Salesforce results to come out later, they had an entire AI day. I tuned into it online. I think our own Brian Sazi, executive editor, was at it. And even as he and I were kind of slacking in the middle of it, One of the things that really jumped out was how many different ways that large companies, some of the largest mega cap tech companies, are just going to figure out a way to either build this out internally themselves, or for some of them, they might just continue to do what they've done before, which is acquire to grow. Is there anything that would jump out to you that we could hear from Salesforce to signal that now this is another NVIDIA type potential multiplier that we could see as a result of some of their efforts in AI?
Yeah, probably the sarcastic response to that, Brad, is simply count the number of times AI is referenced on the earnings call transcript. I'm sure it's going to be quite a bit. But look, we're still in early days, and I'm sure they're going to talk about some of the tools that they're doing, how they're revamping their offering to include AI, probably start to talk about early adoption. To the extent that they speak to that and give concrete examples, I think the more that people will be starting to say, okay, we've heard a lot about the promise of AI. Now we're starting to see, the rubber hit the road. And that's really what we need to see.
So as we look at some of these earnings that we're going to be expecting, especially from Salesforce, Broadcom as well, what is it that you think they're going to need to tell investors to really let them know that, look, AI is obviously a huge focus, but there are also other parts of the business and as well as other competitors in this space to be aware of?
So, just let's think about what we've seen so far this earnings season, right? So, in order for a stock to work, if you will, not only do you have to deliver a solid quarter, but you have to give relatively pristine guidance. And what I mean by that is not just deliver within, what Wall Street's looking for, the would-be consensus expectations, but you've really got to go one step beyond. And again, the shining poster for that was NVIDIA. But we also want to understand where the puts and takes are in the underlying business for that guidance. So, you really have to dig a little bit deeper with Salesforce. What is enterprise spending looking like? And then we've got to compare and contrast that against what we heard from not only HP, but HP Enterprises last night, and what we're going to hear from companies in the next couple of weeks. With Broadcom, again, what are the end markets? I will be listening for what they have to say about cybersecurity for sure, but I also want to understand the smartphone business. Again, what we're trying to do is really take our investment, landscape, our mosaic, if you will. And as we get each company reporting, we want to start to fill in little data points so we can really understand the evolving landscape and then position ourselves as investors for that.
Chris, it seems like investors are consistently looking for these areas of plausible deliverability on some of the most innovative technology, and whether that's in artificial intelligence and where some of the mega cap tech companies are talking about it and then also infusing it into products and solutions, or whether that's, for instance, yesterday when we heard from, of course, the court ruling around the Grayscale Bitcoin ETF, and it's seeming like that might have legs now too to finally move forward. And so for investors that are looking for more of these areas of plausible deliverability, does this signal to you kind of an environment where investors who are looking at some of those more risky assets are going to start nibbling back at that once again?
Well, I think what people are looking for, Brad, is kind of the shift, right? So, if we look over the last few years, there's been a whole number of potentially promising developments in technology, whether it was, blockchain, metaverse, AR, VR, or now AI. And the key here is to go from, is this the new thing? Or is it the real thing? And that's what investors really want to understand. I think to some extent we've been, arguably, this is a little 2020 hindsight, we've been a little head faked on some promises that just really haven't delivered relative to the hope or the hype, if you will. And again, that's what we're starting to see. So the more constructive data points we get that this is real, I think the more inclined you're going to see investors circle back and revisit some of these names.
Always great to get your insights. Chris Versace there, Tematica Research Chief Investment Officer. Thank you for joining us this morning.
Thank you.
You're very welcome. And a quick programming note, we'll hear more about the PC market from Antonio Neri, Hewlett-Packard Enterprise CEO, later today at 3:15 Eastern, an interview you certainly won't want to miss. All right, well, major crypto tokens continue to climb after a ruling yesterday left the door open for the US's first Bitcoin spot ETF. The court sided with Grayscale in a lawsuit against the SEC, ruling that the commission failed to, quote, adequately explain why it denied Grayscale's request to convert its Bitcoin trust to an ETF. Now, the Bitcoin trust in question is up this morning. So far, the SEC has denied dozens of proposals from firms for spot Bitcoin ETFs. Now, this latest decision could change the landscape for Bitcoin and hopeful investors. And Brad, we know that everyone has been, especially Bitcoin enthusiasts, have really been looking for a ray of hope as to what would happen with some of these spot Bitcoin ETFs. And this is a way for people who want to perhaps get in on Bitcoin's movements without having to actually invest in Bitcoin and worry about digital wallets and things. It really does open up the door for institutional investors. So a lot of excitement here as we watch these next steps. And I believe more than a half a dozen spot Bitcoin ETFs are on the deck, including one from Cathie Wood. Her ARC21 shares Bitcoin ETF. They've been trying to get approval since 2021, and she thinks that the SEC, once these do start getting approved, there'll be a flood of them coming in, and it'll really be about differentiating these different offerings from these different spot Bitcoin ETFs.
Yeah, and it's been fascinating to see some of that excitement also overflow into the equities markets as well. Of course, there's the crypto pure play and crypto touching that an investor could evaluate for their own portfolio, but there's also some of the crypto platform plays. And if you were looking at shares of companies like Coinbase yesterday, we were tracking that, of course, in reaction to this news. I didn't see where it ended at, but ultimately here pre-market as well, continuing to track to see how that stock is moving as of right now. So shares of Coin, shares of Robinhood, and of course, you're taking a look at Coinbase, which year to date is actually holding on to some very solid gains of 139%. Yesterday moved higher by 15%. Here this morning in the futures, down fractionally, but all that considered, I mean, a huge move yesterday that you saw for companies like Coinbase, for some of the other platforms. I was taking a look at shares of Robinhood as well, and that particularly moved higher off of the news, at least kind of briefly from some of the lows that I was seeing earlier in the day. And so keep a close eye on where some investors might also look at that, as well as some of the other altcoins that are still out there, as we do know that any spike or any move higher in Bitcoin, like we saw over the past 24 hours by about 5%, has the tendency to move others as well. Well, later on this hour, we'll be speaking with Michael Sonnenschein, who is the CEO of Grayscale Investments. That's 9:30 a.m. Eastern Time. You do not want to miss that conversation. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise. Fresh water, water for industrial projects, water for municipalities, that's going to be a big issue. It's not going to be a big issue this year potentially, but going forward, I think that's one thing investors need to be paying attention to.
Some big moves in the world of Bitcoin. A federal appeals court says the SEC must review Grayscale's bid to convert its Bitcoin trust into an ETF. The decision effectively paves the way for the first spot Bitcoin ETF and more widely for crypto assets to cement their status as part of mainstream finance. Now, shares in the trust rocketed on the ruling. Take a look at that price action. It manages the world's largest cryptocurrency fund and first applied for the conversion back in October of 2021. There was a big reaction across all of Bitcoin and crypto-related assets, including the likes of Coinbase, Riot Blockchain, and Hive. BlackRock, Fidelity, and WisdomTree, they are just some of the firms that have applied for their own ETFs over the last few months as well. Well, joining us now, we've got Michael Sonnenschein, who is the Grayscale CEO. Great to have you here in studio with us.
Great to be here.
So we were taking a look at the reaction yesterday. What type of inflows did you see just off of the ruling itself?
Well, yesterday we actually did see a pretty big spike in trading volume in GBTC. You know, this is the world's largest Bitcoin investment vehicle. It's been publicly traded since 2015. It's been an SEC reporting company since 2020. It's held by nearly 1 million investors here in the US directly within ETFs, within mutual funds. So there are a lot of eyes and certainly a lot of hands looking very closely at the GBTC victory yesterday.
And Michael, Rochelle here. I mean, a lot of people were wondering, questioning the logic. You already have Bitcoin future ETFs allowed. So a lot of people were wondering why we weren't seeing these spot Bitcoin ETFs. What does this now open up? And what's been some of the reaction that you've been getting from investors?
Well, yesterday was really an overwhelming victory, not just for Grayscale and our investors, but for the investment in crypto communities as a whole. The panel of judges unanimously agreed with us 3-0 that the arguments we put forward in front of the court were such that the SEC acted arbitrarily and capriciously by approving the Bitcoin futures products, but not approving Bitcoin spot products like GBTC's conversion. And we really demonstrated, or rather the SEC didn't have a good explanation as to how to make a distinction between these two product types, given that they both derive their pricing from the same underlying Bitcoin market. And so this is a really, really important milestone on GBTC's path to eventually converting to an ETF.
And so walk us through the timeline from this point. How soon could we see the actual spot ETF come forward?
Well, so today is day one of a 45-day period during which the SEC can actually request a rehearing of the case. Okay. So we have to be a little bit patient. We have to follow the federal rules of appellate procedure here. And ultimately, the court will be issuing a final mandate that'll detail the operational next steps. In the interim, however, though, of course, our legal teams will be proactively working with the SEC to try and make for an expeditious as possible conversion of GBTC to an ETF.
Now, Michael, I do have to ask, if the floodgates do open and this is finally approved, how will you differentiate your product from some of the other ones that have also been applying for spot Bitcoin ETFs?
It's a great question, Rochelle, and there's actually already quite a bit of differentiation. GBTC is just a couple weeks away from celebrating its 10th anniversary. And that's 10 years of, operating within the digital asset ecosystem, custody, audits, accounting, disclosure, creations, investor disclosures, tax treatment. All of these things are really core to running GBTC every single day. And in contrast, a lot of the other products seeking to come to market are merely just ideas. They're just ideas on paper. They're just filings. So in a lot of ways, GBTC has paved the way for a lot of the other issuers to even think about bringing their products to market, making use of GBTC's operations, disclosures, financial reporting, et cetera. And I think when investors do have a choice about which product to invest in, certainly thinking about a crypto native asset manager, a product that has billions of dollars of assets, hundreds of millions of dollars of daily trading volume. These are the types of distinctions that I think investors will be paying attention to, but ultimately we do believe investors should have choice.
So is this ruling enough to really kind of overshadow some of the crypto winter detractors to cryptocurrency, whether that's SBF and FTX and what's taking place there, or whether that's the algorithmic stablecoin debacles of last year and the depegging basically to the dollar? Is this enough for investors and for the sentiment that's moved forward and had to navigate so many of these issues?
Certainly. I think investors are paying attention to the fact that crypto has been one of the best performing assets year to date. They're looking at not only the Grayscale victory, they're looking at the recent Ripple victory in court. They're looking at the pending legislation that's being worked on in Washington, both around stablecoins, as you mentioned, as well as looking more at market structure. And it's encouraging from my seat, having been in crypto now for almost a decade, to actually see crypto becoming a nonpartisan issue, to see both sides of the aisle working on legislation. Their constituents are getting involved in crypto. They're getting involved in the name of investor protection. They realize investors are going to be involved in this asset class no matter what. And so I am very encouraged that we will have some progress around a lot of these in the weeks and months to come.
Who does this benefit the most? Who stands to benefit? Is it the retail investor that has been, bullish on Bitcoin for the past 10 years, say, as long as you've been involved? Or is it the institutions now in making this more accessible and them being able to make sure that they've seen some type of revenue come through as a result of any products or assets that they might bring to market?
Ultimately, I think an ETF is a wrapper that is tried and true, and it's been used for everything from gold and other commodities to equities to, sub-themes. And I think there's no exception when it comes to Bitcoin, right? Investors appreciate the ETF wrapper as a way to give them greater protections. And this is a wrapper that's used both by retail investors as well as institutions. So I think this is an overall win for the investment community as a whole if we move forward with seeing these spot Bitcoin products like GBTC converting and coming into the market.
And Michael, I do have to ask, because when you think of where Bitcoin and crypto started, and now you have this influx of institutional investors, and when then waiting for the next catalyst, whether it be Bitcoin halving, what do you think is going to be the next catalyst in the crypto investment space?
Well, I actually think, Rochelle, you nailed it. One of the things that we and our investors are very focused on is the next Bitcoin halving that's slated to come around early next summer. And as we think about both that as well as the regulatory and legislative landscape I just mentioned, I do think that it portends for an environment around crypto like we actually haven't seen before, and some catalysts that could be really, really unique to continuing to underscore the staying power of the asset class.
Well, hopefully we'll have you back to discuss that when that happens as well. A big thank you there for joining us this morning. Michael Sonnenschein, Grayscale CEO. Thank you so much. All right, well, we have your opening bell on Wall Street that's rung. Let's do a quick check of the markets. We're seeing green across the board here, though still trading in a relatively narrow range here, but the Dow up about 60 points, the S&P 500 also there up barely by about 8 points, and the tech-heavy Nasdaq also up about 25 basis points as well. Let's head over to Brad Smith at the Yahoo Finance Interactive. So, Brad, what else are you taking a look at right now?
Yeah, looking at a lot of the green on the screen right now. Rochelle, taking a look at the major averages that you just ran through, and we've got some fractional gains across the board. The Dow up 0.2%, Nasdaq up 0.2%, S&P 500 0.2%. All right, so let's also take a look at some of the charts. Let's put this in a line graph for you here. Over the past 3 days, higher for the Dow by about 1.7%, Nasdaq Composite, that too holding on to gains by about 2.8% over the past 3 days, and then the S&P 500, you're seeing that move higher by about 2.25% over the past 3 days, but it really all kind of kicked off yesterday. Of course, I don't have the marker lit up, but now we do. This was yesterday when we saw that JOLTS report come through that really gave the markets a little bit more of a sense in the bad news is good news environment where you've got a pullback in the number of job openings. Perhaps that means even less options or less of the movement around, or at least signaling that the consumers out there or people that are in the workforce in that labor force participation are thinking or feeling like, okay, maybe this is signs of a recession if some of those openings are pulling back, and corporates and all of the kind of listings, if those continue to pull back, that could be a further restructuring more broadly of the mindset around the workforce right now and the employment situation. And so we'll see what that means, especially as we come into the jobs report on Friday. Of course, we got ADP private payrolls earlier this morning out that we broke down earlier. I do want to take a look at the S&P 500 heat map here on the day just to give our viewers a quick look at some of these sectors and how that's playing out this morning. Utilities pulling up the caboose. Flat just barely to the downside. We'll see if that can get right. But staples right now leading the activity. That's up by about 0.4%. So all in, you're seeing some mixed activity, but more leaders than laggards right now. Take a look at the Nasdaq 100 as well. Some of those mega cap tech stocks for you. You've got Apple, Microsoft, and Alphabet or Google, Alpha Google, whatever you want to call them up right now. Nvidia also up by about 0.8%. And then additionally here, I'm going to see if I can locate one name that's going to be reporting earnings later on, and that is Salesforce. Coming into that earnings report, you are at least seeing, at least at the start of the day, shares lower by about 0.5% right now. So continuing to keep a close eye on that. And then lastly, we'll just ride out with a quick look at some of, we'll just go over to the Nasdaq Composite back there for a hot second here, just to give you a better look at an overall heat map that is mostly green, mostly green, but a little bit of red there. And TXN is one that we're going to break down for you here in just a little bit. That's down by about 2.7%. Rochelle?
All right, thanks, Brad. Also taking a look at shares of HP Inc. slipping today after the company lowered its full-year outlook as it deals with softening demand for its electronics and a 19% drop in PC shipments to China. So, Brad, as we look at this, it was a mixed picture. A lot of analysts weighing in here. We saw from JP Morgan analyst Samik Chatterjee, who has an overweight rating on HP, but tweaked his price target on that full-year outlook, but says the company is still on the path to sequential recovery. So a little bit of cautiousness here, really tempering some of the bullishness that we had seen. A lot of people wondering how much recovery we're going to see in some of these bigger ticket items like PC volumes and sales as well. And then also looking at that full year free cash flow of about $3 billion. That's also below the previous estimate of between $3 and $3.5 billion. That came in below expectations as well, Brad.
Yeah, a larger question of when we would see a swift turn in the PC demand here. And that is one thing that started to come up a little bit in this quarter. But taking a look at shares of HP, this has still been a challenging overall environment for the company as they've tried to get past that lull in PC demand, and you're seeing shares moving lower by about 9.8% this morning, and that is kind of in this broader context of the move over the year, where they're still holding on to gains of about 6%. It's really just this move on the day that's putting a dampener on things here. And we saw, I don't know if we could toss that back up, just kind of the line by line or segment by segment for this company, and that PC side was particularly of note here. Personal systems commercial, that was up 47%, and then personal systems computer up 21%. So those two, and then combined with printing supplies, some of the largest year-over-year gains that we had seen in revenue by segment there. So continuing to watch the share price reaction here, slumping on the day. We have also got to talk about shares of semiconductor company Ambarella, not a company we talk about all the time, but they are plunging today after forecasting third quarter revenue well below estimates. Saw revenue fall to $62 million in the second quarter from nearly $81 million a year ago. You're taking a look at shares right now. The reaction, they are moving lower by about 20% for shares of AMBA. AMBA is your ticker symbol there for anybody keeping tabs on this one, and no doubt one of our trending stocks here on the Yahoo Finance platform today, Rochelle.
It's true. And we saw some downgrades. We saw one from TD Cowen there to market perform from outperform, reducing their price target to $65 from $90. The stock has really been under pressure as we look year to date. It was already declining pre-market this morning, but as you can see, they're off about 26% year to date and really taking a hit this morning as well. That weak revenue forecast for Q3 not helping. Also seeing some issues when it came to core video processing in the P&L and strategic revenue as well. So some concerns there, but Ambarella has, at least according to Seeking Alpha, they have a hold rating. So analysts really trying to make sense of this environment for Ambarella at the moment. Yeah,
just briefly here, one thing that I will add on, this is a statement from Fermi Wang, who is the president and CEO of Ambarella. They anticipate their customers' inventory levels will normalize by the end of the year and perhaps set them up for a return to growth in the next fiscal year. So that part of their projection or their forecast also goes on to say our mid to long-term outlook for our AI inference processor. There's another AI mention here this earnings season. Their business remains positive, and R&D really focused right now on products targeting more sophisticated AI inference workloads here. So a lot more chatter about AI. Ambarella, of course, had to make sure that they weave that into their conversation too here, Rochelle.
And also taking a look at Texas Instruments, they were hit with a downgrade from Bernstein this morning from market perform to underperform, citing the company's, quote, longer investment horizon as it raises its spending. I mean, a lot of focus also on what we're looking at with gross margins. I mean, Razgon saying that, look, it's likely headed towards a 60% level or worse in short order. So a lot of concern here coming out of that note, and really wondering what the long-term plan is. And I think people are going to want to hear a lot more details before they sort of get behind this company at the moment. But looking at the numbers, it's at the lower end of the street as far as gross margins, and revenues also taking a toll as well. So we're seeing this very, very cautious attitudes around them over the past week. As we can see, they're down about 1.6%. But as we look at the past 3 months there, it's been a roller coaster for them this summer. And you figure, with back to school spending as well, perhaps they should see some pickup that'll show up in the later on earnings. But for now, really under pressure at the moment.
Oh, you're talking about that TI 84 Plus calculator. I love a shout out for the good old graphing calculators out there. Look, 2 shout outs though as well, or 2 call outs from this note. They said the street models do not appear to contemplate the consequences of Texas Instruments' plans, and gross margin expectations appear far too high for us. It seems highly likely to us that gross margins are headed towards the 60% level in short order or worse, well below current expectations here. So that alluding to part of what you were saying a moment ago, Rochelle, and they went on to say, we're not suggesting Texas Instruments is wrong or bad in their strategy. They just have a longer investment horizon than most other companies. However, horizon also likely longer than many investors have as well here. And so there you're taking a look at Texas Instruments as compared to some of the other semiconductor stocks and the price action in the markets here today. Texas Instruments, the worst performer, at least of that bunch pictured here on screen right now.
Indeed. Well, stay with us. We'll have more of your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Here's a random one. What do you make of VinFast?
SPACs are back.
Are they though?
No, they're not. But selectively they are. I mean, you know, VinFast has everything, everything you'd want in a meme-like stock. I'm not going to call it a meme stock, but it's electric cars. It's a very thin float. It's non-U.S. based, and some of we've seen much more crazy trading in some of the new listings that have come out of Asia rather than the ones that are domestically focused. And so you've got all the ingredients. Is this company worth more than Ford and GM at this point? It seems ridiculous, but that's not. If you're trading VinFast or if you're investing in VinFast, you're not thinking in those terms. You're saying, oh wait, this stock can double in a day or triple in a day, and oh, if it goes down 50%, maybe it'll come back next time. So it's which it has exactly. So you've had everything in its short lifespan.
Yeah.
For the first time since 2019, the S&P 500 and copper are no longer moving together, which RBC Capital Markets is attributing to the stark contrast between the US economy and weaker data out of China. For more on this, Yahoo Finance's Jared Blickery joins us from the floor of the New York Stock Exchange. Hey, Jared.
Hi, Rochelle. It is no secret that the copper has really disappointed because China has disappointed this year. I'm looking at the Wi-Fi Interactive, a year-to-date chart of copper futures, and we can see the downtrend ended in May, but we are still having trouble just kind of getting off the dime here. And you mentioned the comparison with the stock market. I'm going to chart SPY, which is an S&P 500 ETF, alongside CPER, that's a US copper index fund. Now, this purple line, which has gone up over the last few months, although it's gone sideways over the last few weeks, that is the S&P 500, that is SPY. Meanwhile, we can see copper just kind of languishing down by those lows. Now, let's compare that to a 2-year chart where you can see them moving more or less in lockstep. Had that big dramatic downdraft last year, and here's that big up move that we saw in SPY this year. I would note that copper did bottom first, but overall the movements have been tightly correlated. So it's interesting to see when there's a divergence. We would either think copper will catch up with the S&P 500 or the S&P 500 will catch down. So we'll have to see how that turns out. Also want to check out small caps overall. This is going to be the Russell 2000 versus the Goldman Sachs Commodity Index. Now, the GSCI, that is in this cyan line right here, this peaked in 2022, while the bear market in Russell in small caps was just getting started. That was a bear market in all stocks. And you can see that the commodity index have been trending down, and it just broke out of this broke out of that downtrend, and we can finally see that it's trying to kind of stabilize, but we're just in the beginning stages though. We'll have to see how this works out. Now, one of the things that really is working in the favor of stocks right now and also commodities is the fact that volatility is going down, and we're also seeing a back off in the US dollar index. Here's the Dixie US dollar index, and you can see we have fallen off of these highs over the last few days after this very steep incline. It's not impossible for stocks and the dollar to climb in tandem, but it does make it a little bit more difficult. And the dollar is a headwind in everything, including multinational, a stronger dollar anyway, multinational corporations, commodities, even crypto. So a weakening dollar even helps the crypto trade guys.
All right, Yahoo Finance's own Jared Blickery down there on the floor of the New York Stock Exchange. Thanks so much, Jared. Appreciate it. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. What is the state of the consumer from your perspective right now?
I think we're spending ourselves silly, and we want to keep going. There's still a lot of revenge spending going on right now, so we keep doing it, and credit card debt is at a record high. That said, we have had wage increases, and those that have felt the impact of those are feeling more comfortable spending right now despite inflation.
The revised estimate for US GDP came in at an annual rate of 2.1% in the second quarter. That's down from the first estimates of 2.4%, as a drop in exports offset the tick higher in consumer spending. For more on this is David Doyle, Macquarie Group Head of Economics, joining us now. So I want to get your takeaway from this revision as we try and understand the actual health of the economy and what this actually means for the Fed's job as they try and manage interest rates with this sort of data in mind.
Yeah, so this is a fairly modest revision. I mean, just down, 0.3 percentage points on an annualized basis to 2.1% versus 2.4% previously. And the underlying component suggests that, a lot of that was due to, or at least a hefty component of that was due to the pace of inventory building, which actually mechanically, could provide a boost to 3Q growth. So I'm not overly concerned about, the revisions that took place in terms of what they're suggesting about the pace of growth in the second quarter. But what I did find interesting is that we did get the first release of real gross domestic income, which is an alternative way of measuring output. And, historically over time has tracked real GDP quite closely. That came in at just 0.5%, so plus 0.5% on an annualized basis in the quarter. So suggesting that growth was a fair bit weaker. And that sort of continues a trend in divergence that's occurred over the last 4 quarters or so in those two measures. And it suggests to us that potentially the economy isn't as strong as what the headline real GDP numbers are suggesting.
How can that play into the mind of the consumer from your perspective, David?
Look, the consumer, we think, is poised for some struggles ahead. In large part, the gains that we've seen over the past year or so in consumption, they haven't been underpinned by strong real income growth. It's been more driven by a reduction in the savings rate, a reduction in the excess savings that had been built up during the pandemic. And as we look ahead, we think those are unsustainable sources of spending growth. As we look ahead to the coming quarters, there's challenges ahead. The pace of jobs growth is slowing. Credit availability is tightening for consumers. And then, of course, in October, student loan repayments are set to recommence. We think that'll only add to headwinds. So we actually think that consumer spending is set to slow ahead, and that could weigh on the growth outlook in the back half of 23 and into 2024.
And David, as you look at some of the stronger parts of the economy that are propping it up at the moment, what are the standouts for you?
Yeah, so there's 3 major standouts for us within business investment, and actually these 3, business investment had been an area of strength in the second quarter numbers, but a lot of that has been very concentrated. Manufacturing structures has shown phenomenal growth. A lot of that is related to the semiconductor industry and is coming on the heels of the CHIPS Act that was passed last year. Then you have transportation equipment, so aircraft, cars, like trucks, et cetera. That type of business investment has also been quite strong. And we think that really reflects supply chain healing. And then the third component, which interesting, tailed off a bit in the most recent revision, was software, which could be related to, AI spending. A bit unclear, though, in terms of what the mechanics are there. But those are the components that are really driving the business investment, which tends to be the most cyclical component of growth. We're skeptical on the durability of those components to drive business investment growth going forward.
To what extent is the GDP kind of calculus also kind of impacted by some of the weakness that we're seeing in other parts of the world, and most notably in the second largest economy in the world, in China?
Yeah, so there hasn't, I don't think that there's been much pass through directly from China into the U.S. economy. The U.S. is a largely, I would say, independent economy from that perspective. It has less trade outside of its borders than most other economies. And the trade that it does have, it tends to be with Canada and Mexico. It tends to be within those two components. The exports to China are fairly low. So I don't think that we've seen much impact yet on the data coming through from China. But that doesn't mean that it won't be forthcoming. You could see that in coming quarters ahead.
And David, as we look at the likelihood of a recession in the U.S. economy, I mean, some people are saying it'll be a soft landing. Others are saying, look, markets really aren't pricing in enough of a recession risk. Where do the estimates lie now?
Oh, I think opinion on that is still, I think, pretty divided. I think what you've seen over the past number of weeks, at least up until the last couple of days, was a period of very strong U.S. data where the numbers were coming in well above the consensus forecasts, and you saw a big increase in the economic surprise index, reflecting that. What do we think that means for the recession risk? Well, I think what it means is that while the recession risk is still out there, the timing remains quite nebulous. It's very difficult to pinpoint when things might deteriorate. People have been, I think, revisiting the timing on things in light of that recent positive data over the past several weeks.
David Doyle, Macquarie, Head of Economics. Thanks so much for joining us here this morning, David. Appreciate it.
Anytime. Thanks for having me.
Thanks. All right, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. What's the streaming service you can't live without?
Right now, I'd probably have to say Amazon. I got a few shows on there that I can't.
Which one gets cut then? If because every household has like 3 or 4 streaming services. Which one has to, unfortunately, get the axe?
Unfortunately, I just cut Disney because we had it and I really wasn't watching it a lot and my kids weren't watching it, so we just cut that. We may go back with the bundle. Some of my favorite shows, though, happen to be on Hulu, like The Bear, but Amazon is the one I probably spend the most time on.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. We're about 32 minutes into the trading day. Let's take a look at how stocks are moving this morning. They're higher as more news of slowing in the economy boosts investor sentiment. Interesting here as traders are hoping the Q2 GDP print, now revised lower to 2.1% growth and lower private payrolls from ADP, could mean the Fed won't hike rates again this year. Still, we have Powell's favorite inflation gauge, PCE, and the jobs report coming this week that we will be watching.
That's right, Brad. And also, solar storage and energy services company Sunrun seeing its stock trending upwards today. This comes after Citigroup upgraded Sunrun's rating from neutral to buy. Despite the upgrade, though, analysts revised their price target from $25 to $21. Still, Citi says the company is well positioned to navigate a challenging residential market, Brad.
And HP Enterprise extends losses from after-hours trading following its earnings report Tuesday night. The company delivered solid results in its third quarter, seeing strong growth in its networking business and demand for high-performance computing amid the AI craze. But a lackluster revenue outlook is weighing on investor sentiment right now.
And VinFast, the Vietnamese EV car maker, sees its stock go up this morning. Now, this comes after a tough trading day for the company on Tuesday, after short seller Jim Chanos called the company a, quote, meme stock, sending shares down 44%, snapping a 6-day winning streak. Before Tuesday, VinFast grew more than 800% since debuting just 3 weeks ago. And the little-known EV company has a market cap of over $100 billion. Well, crypto tokens continue gaining after a federal appeals court sided with Grayscale in a lawsuit against the SEC, ruling that the commission failed to, quote, adequately explain why it denied Grayscale's request to convert its Bitcoin trust to an ETF. The trust issuer manages the world's largest cryptocurrency fund and first applied for the conversion back in October of 2021. Now, the SEC has denied more than 30 proposals for spot Bitcoin ETFs, but this latest decision has boosted investor confidence. Here to talk more about Grayscale investments and Bitcoin, Axios reporter Brady Dale. Good to see you, Brady. So, obviously, a very interesting development here, and we were speaking with Grayscale CEO earlier today, really about the potential for what happens next and the floodgates that could open. But what should the investment community take away from this?
Well, I mean, Bitcoiners have been wanting an ETF forever. So they were extremely excited when some positive news came for this yesterday. And if an ETF got approved, Grayscale's or any ETF, it means it would be vastly easier for lots of people to buy in. But we're still in a waiting game. The SEC could appeal, or they could decide not to appeal, but they could still drag their feet until next year in terms of approving any of the ETFs. There's a lot of variables still at play, but you know, this is the SEC's second major losses in the courts this year, and they can't be feeling quite as ambitious as they were coming into 2023. Is
this a ray of sunlight, perhaps, at the end of a long crypto winter that we've seen that has been detrimental in many factors for cryptocurrency?
It's a gigantic ray of sunlight. I mean, this is the gigantic thing Bitcoin people have been waiting for as long as I've been covering this industry. They have wanted an ETF forever. And I see, you know, we had a giant bump in the Bitcoin market yesterday when the news came out. And I see several more bumps ahead if we move towards an ETF passing. You know, like if Grayscale's ETF goes live, that's a bump. If Fidelity's ETF goes live, that's a bump. If the SEC decides not to appeal, that's a bump. Like there's a bunch of possible bumps ahead. Now, the SEC might fight tooth and nail, and so none of those things happen. But, you know, there's a lot of possibilities for things to move forward.
And how should people be looking at Bitcoin prices? I mean, because Bitcoin and some of these other cryptos are still below key levels here. So in terms of the tokens themselves, we do see analysts sort of on the fence about what's actually going to happen from here. There's always these very lofty valuations as to where Bitcoin is going to go. But what's the reality showing us right now?
I love this question, Rochelle. So there's a really exciting answer to this question, I think. We are in a new world, at least in terms of Bitcoin now, that we're in a world that Bitcoin has never seen before. And what's different about this world is we're no longer under zero interest rate policy. Bitcoin was created under zero interest rate policy. Every single boom we've had so far has been in a zero interest rate environment. And now there's actually yields that investors can get, you know, like off of treasuries. I mean, that's the thing everyone's got to compete with. And so Bitcoin has never been up against this environment before. It's a completely different world. I mean, it is the normal world. It's the way it's the way that investing has been in the United States for most of time, but it just hasn't been for a very long time since the Great Recession. So the next big boom, I think, it'll probably come, but it could be more muted this time because, investors aren't piling into risk assets in quite the same way now that they have like actual yields they can get off of treasuries again.
But does it take other cryptocurrencies with it? Or is it just all Bitcoin, and that is, even though it, of course, is the largest kind of market cap of the total crypto market cap right now, is it just zero-sum Bitcoin after a ruling like this?
Oh, I can't imagine a world in which a boom in Bitcoin doesn't yield a boom in everything else, just like it always does. Yeah.
Sure.
And we know that when it came to even classifying Bitcoin versus other cryptos as securities versus assets, Bitcoin has seemed to be in its own lane at the moment. Do we see that changing as we look at sort of some of the potential regulation or sort of regulation by violation as we've been seeing when it comes to some of these exchanges and tokens? Do we expect more of that? Any standouts coming ahead for you?
Well, I mean, the SEC's other big loss this year was the decision on XRP, where the courts found that XRP wasn't a security, which a lot of people have questions about that ruling, and the SEC is going to try to appeal it. But we also have Congress looking to create a new definition for different kinds of cryptocurrencies. And so this world in which Bitcoin is the only cryptocurrency that is not a security, it's hard to imagine that lasting forever. The question is just how long until a few other cryptocurrencies get the green light to sort of trade normally like Bitcoin has.
And so is this for an industry that's saying, regulate us, regulate us,
Right.
regulate us, so we
Yes.
know how we can move forward
Yes.
with the necessary boundaries.
Yeah.
Is this the first piece where we see this opening up a floodgate of other regulation that then paves the way for people to know how they can engage with, and for companies who are trying to introduce assets to know how they can engage with consumers as well?
Well, I still think this SEC is going to fight crypto in every possible way it can, but Congress really wants to change the rules. And if Congress changes the rules, SEC has to follow. So I guess in terms of like really giving the industry a path forward, my bet is either on Congress acting or a new president. I don't know that Gary Gensler's SEC is ever going to like create that path for cryptocurrency. So they have to wait a while if it's just a regulation question.
Does that mean crypto's on the ballot in 24?
I mean, it's definitely a voting issue for some people. I don't think it's going to decide the election.
Not everybody, yeah.
Yeah.
All right, thanks so much. We
Thank you.
appreciate it. Brady Dale, Axios Crypto Reporting.
Brady.
Yo, yeah, Rochelle, go ahead. Sorry.
I was going to say, Brady, before we let you go, because we know you had that recent piece on Sam Bankman-Fried. Of course, he was the golden boy of the day. That was the last time we saw this many headlines surrounding crypto here. Talk about what this does for the industry in terms of who do they look to now for regulation and sort of corralling this all together, especially when you have more institutional investors pouring into crypto?
Well, I think the leader in the U.S. crypto industry right now still has to be Coinbase, and Coinbase is showing itself to be super proactive. So I guess the new I mean, they would hate for me to say this, but the new Sam Bankman-Fried is Brian Armstrong, right? And Coinbase has showed itself willing to fight for its right to exist. I mean, really, the SEC case against Coinbase is existential for the company, so they have to. They've got deep pockets. They're going to fight. They're going to fight both in the courts, and they're going to fight by going to Congress and looking for new rules and trying to get the SEC to promulgate new rules. So I guess Brian Armstrong is the new Sam Bankman-Fried.
All right. Brady, we're going to be watching closely to see what comes of any court case that moves forward, especially within this industry. All eyes on that. Brady Dale, Axios Crypto Reporter, thanks so much for taking the time.
Thank you both.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Student loan payments are coming back very soon. What are you watching for in terms of the effect from that?
Yeah, so speaking of the consumer, Americans will have to start paying back their student loans. I think it'll be important to watch the younger consumer, which, by the way, has benefited a lot from this job market, gotten the brunt of wage growth and the brunt of kind of employee power as well. But I'm looking at that segment of consumer and, just exactly how their spending habits change.
Do you think it will have a negative effect?
It'll definitely have an effect, probably negative. But I think the degree to the effect it will have is something that everybody's still debating about.
Lego had a stellar first half of the year. The Danish-based toy company reported stable revenue of just under $3 billion for the first half of the year, up around 1.5% from the year prior. Yahoo Finance's executive editor Brian Sazi has more on the company's latest results.
Joining me now is Lego Group CEO Niels B. Christensen. Niels, great to see you here, offer your latest results. You know, we've gotten, I think, from a U.S. investor perspective, a lot of different mixed reads on the toy industry, some doing good, some doing not so good. From your vantage point, what's the state of Lego?
I think I'm very satisfied with where we are. I think we've continued our 5-year stride to take market share, growing considerably ahead of the market, and we've done that again. Now, this time in a market that is has been slightly more negative than it has been for the years before. But I just think we have to keep in mind that we've had a kind of rapidly growing toy market for 2 or 3 years now. Maybe this is a little bit of an adjustment to that. And the 5-year average growth in the toy market, I think, is pretty much where it should be. Now, we've been able to every year take market share to the tune of growing 10 percentage points faster than the market. And the same is true here in this half year. The market is down 7, we grew 3, and I'm pretty satisfied with that.
You talk a lot about in the release taking market share, and you just mentioned it now. Where does that market share come from? Is it other toy makers? Is it other play experiences?
Wait, I think it's a combination. It's a bigger share of the total toy market. So everything that's included in the toy market, that's what we fight over share. And at the end of the day, I think it's also children's time. It's what children do. It's what they play with, and we are just owning a bigger share of that year by year. And I think that's right on our mission.
You know, we're still trying to get beyond the pandemic, Niels. How are children playing differently than before the pandemic? You know, I imagine you do a lot of studies and a lot of observations inside the company.
I don't think we can say that they're playing dramatically different. I think there's been different patterns, you know, during the pandemic where we were all at home and parents were at home, and maybe there was a tendency of playing more together as a family. Now maybe it's back to normal in that sense. But I think for us, we see kids having a lot of different passion points. And we serve those. Every year we grow our portfolio of Lego products, and that allows us to tune in and focus in on passion points that are there. And I think that together with the brand works really well for us.
How are you designing Legos differently? How are the sets different today compared to a couple years ago?
Yeah, I wouldn't say there's a big difference to a couple of years ago, but I mean, maybe one example on your question is we relaunched Lego Friends. Lego Friends has been around for more than 10 years. It is what we call a girl's first product. It really tries to be into the how characters interact and what capabilities characters have, and we updated that to really better reflect the type of characters, the type of interesting topics for particularly girls, but for kids today. So in that sense, I think it is moving, not year on year, but it has over a decade really moved. And I think we brought some interesting characters. We also brought different disabilities into the picture. So it's a better representation of real life in the sense. And we just know from all our studies, kids really like to see themselves and real life things happening also in toys.
Why do you think the U.S. toy industry has been challenged this year?
Yeah, I wouldn't say the U.S. toy industry has been particularly more challenged than the rest, but I do think, and you were alluding to it, the fact that we've had a pandemic and we've seen different spending patterns throughout a pandemic, and now we are back to what I would consider more of normalization, and I think that's what it is. And looking over the 5-year period, including the pandemic period, I actually think things have developed pretty well. There's just been spikes and valleys on the journey.
The major retailers that you sell into, they remain pretty focused on lean inventory. Target, Walmart, you name it. How are they planning for this holiday shopping season?
No, I think I mean the signals I'm getting are pretty good. I think our brand is doing pretty well right now. So we can also see in our results we haven't had a big between consumer sales and revenue. That's where you would normally see building up and down of inventory. We haven't seen a big issue on our stock because it's been quite relevant all the way through. We didn't build it up big time during last year. So I think in that sense, it's relatively balanced, and I don't see a big difference to normal when I look into the in-season and how they prepare for it.
Speaking of the U.S., your company is making a big push, a big investment, a new headquarters, what I believe in Boston, a new factory in Virginia. Why these big bets in the United States?
I mean, the US is the world's biggest toy market, and we've made really, really good progress. We've really gotten to many more kids around the US, and we want, on supply chain wise, we want to be close. We want to produce close to where we actually sell the products, because we don't want long transportation. We want a low CO2 emission around that, and we like the proximity to consumers. And that's, I think it did us really well through the pandemic period, that we were not the ones that had to transport product throughout the world from Asia or whatever. We produce close to consumers. We produce also close in time. So when we approach in season or Christmas and we know what's actually high on the wish list, then that's what we produce. And that helps us not to sit by January 1st with a lot of wrong stuff at inventories at our retailers. And I think that's kind of our business model that works pretty well. And there, Virginia is really key to this huge market, the US is, and the progress we have. So I'm looking forward to get that on stream in 24 or 25, actually. Yeah.
Within the factories that you currently operate that are open, the Legos that run through these factories, what are you seeing on inflation? Because I imagine, folks that are reading the release on earnings, they see the operating profits down double digits, whatever it might be, and they think that inflation is still a problem for the toy industry. How do you see it?
Yeah, I think there's a couple of elements. I think just to put the 19% drop in EBIT into perspective, we really, like the 2 years before, we doubled it on 2020. So it's like it's 100% up and 19% down. That, in my math, is still 81% up on 3 years ago. That's not that bad, actually, in this industry. So in that sense, I think we should be more focusing on the level. I think it's a strong level, but it has been impacted by the higher input costs. I mean, for instance, the raw materials that we brought into factories, some of that has spilled over, had a tail into this first half. Now we're out of that. The prices have normalized a bit, so I don't think we see it in the second half. But there was a bit of pressure on the first half from that. Going forward, I think things are looking better on that point of view. The other part is really all the investments we have decided to do ourselves. And that's in the factory expansions we talked about. That's in sustainability across all the different measures. That's building our digital capabilities. We have now 1,800 digital experts working just on providing digital experiences for kids and digitalizing the company. That's an investment that's not for this year or next year. It's an investment for the long term. And we have just decided to take those and to run them through and not make those kind of longer term investments dependent on whether the toy market does better or worse in a half year.
China, a key market for Lego. Have you seen the slowdown there that a lot of other multinational companies have seen?
Yeah, or rather say we haven't seen kind of the acceleration out of the pandemic as fast as we had anticipated. So China, as you know, was a little bit later in the pandemic, came out of the pandemic later, and we had kind of assumed that they would return to traffic in stores and consumer spending the way we've seen it in other countries. And I think we've been a bit disappointed that happens quite a bit slower. So we're not exactly where we thought we would be at this point in China. I don't think it changes the fact that it's a big market with a lot of kids and an opportunity for our brand. So we're keeping our investments going. We're building stores in China, but we have seen that happen a bit slower.
So you're not pulling back on investments in China. So how many stores will you open this year? And how many stores do you have there now?
We have now just short of 500. We opened 54 this first half, and we'll be opening another 30 this year. So we will get past 500 Lego branded stores in China by the end of this year. And as we talked about, we are increasing or expanding our factory in China. So we're building to get the brand out in China, but we're building everywhere. We're also making investments in Vietnam and in the US, and so it's not it's not a single-minded China strategy. It's an opportunity to get to as many kids as possible, and China is just part of that strategy.
Before we let you go, this is your first time on Yahoo Finance, so again, thank you for coming on. But as the CEO of Lego Group, what sets do you put together? How do you interact with the brand? How long does it take you to put together, something like that Starship behind you? I mean, give us some secrets behind the curtain.
Yeah. I'm afraid I cannot say that I'm the fastest builder in the world. I'm sometimes really impressed when I see some either kids or adult fans that are really, really good at building. I would like to build more than I do. I like to build vehicles, so I'm into vehicles, and I think some of those we've done have been just amazing. So those have been most of my builds. But I really do like it, and I'm just amazed about when I take a walk in our innovation department where the Lego designers sit. That is out of this world, the kind of creativity they bring about and how they do that, and that almost is as good as building.
Why do people love the Lego brand? So I just went around our office, and as soon as I said the word Lego, people's faces light up. It's a brand that I think you go to many other places and they have that same emotion to it. I mean, why do you think that's the case? Have you studied why?
Yeah, I mean, we're looking into that. It's I have the same experience no matter where I go, no matter who I talk to. I always get the Lego story. I get this smile, and I get a positive attitude to the brand. I think it has to do with the fact that, I mean, we are family owned. The family has owned the company for 90 years, and there's been a very strong red thread on values through that. So the brand has not been built overnight or changed a lot overnight. So it's a matter of being, I think, super consistent, and having been that all since you and I were kids and we were playing around. So it is in essence the same brand. I also believe that we are honestly investing a lot in the brand, in sustainability, in providing experiences for kids that really matter. We are into learning through play, that we want to make sure we are part of allowing kids to build skills they need in life. So I think there are a lot of things undergoing. The Lego Foundation owns 25% of the company, and that 25% of dividends goes to the foundation, and it's donated out to kids in need, to things that would benefit kids. So there is a real authentic, thorough reinvestment into society and into kids that I think really benefits the brand as well. And then I'm super proud that in April, in RepTrak, we were named the most reputable company in the world. Now that's something that humbles you, and I'm super keen to see if we can stay high on that list at least.
Well, it's a real pleasure to get some time with you and talk all things Lego. It's a brand we all know here and very much enjoy. Lego Group CEO Niels B. Christensen, great to get some time with you here first on Yahoo Finance. We look forward to continuing to follow your journey.
It's true, Lego does always put a smile on your face. A big thank you to our very own Brian Sozzi for that interview. Shifting gears now to Medicare, it achieved a milestone Tuesday by announcing the list of 10 drugs that would be the first ever to face price negotiations. Now, some analysts were surprised by a few of the picks, but remain confident that all drugs represent no real threat to company earnings. For more on this story, we're joined by Anjali Kemlani. Anjali, I know you've been following this for us.
That's right, Rochelle. It's definitely interesting to see some of the picks yesterday. Of course, many analysts had already picked and targeted some of those drugs. But I got an interesting note from JPM looking at those picks, saying that overall the update was largely expected, with key drugs like Eliquis and Imbruvica on that list. But Stelara from Johnson & Johnson was a surprise for many because of the fact that it faces biosimilar competition in the upcoming years before the 2026 year that this goes into effect. However, the rest of the drugs are small revenue and earnings per share contributors to their company. So JPM doesn't really see that. And I saw that theme repeated in many of the notes that came out yesterday. But what I started thinking about also was how much of that is true when it comes to the earnings and the profit, or rather the sales from these companies. In the time period that CMS looked at, which was June of last year through May of this year, I did a little bit of back of the napkin math to take a look at Eliquis first, for example. CMS did say that in that time period, the cost to it for Part D beneficiaries was $16.5 billion. And that total seems to match what Bristol Myers Squibb and Pfizer, who both share in the profits for this, did mention in their quarterly earnings in that time period. And that's, if you compare that to their total revenues for that time period, Bristol Myers Squibb saying that $57 billion is what their total revenues were for that year, and nearly $78 billion for Pfizer. And then I looked at Stelara, the surprise pick. That was on the lower end for Medicare, $2.6 billion as their cost. And then meanwhile, Johnson & Johnson saying in that same time period, again, last June to this May, $12.7 billion from Stelara alone. And if you compare that to the total company's earnings of $121.7 billion. You can see how it does contribute a smaller amount. In the previous example, we did often see Eliquis cited as a driver of earnings for those two companies. And Solara has always been called out as a strong product. So it will be interesting whether or not those LOEs, that loss of exclusivity, is that driver behind those comments for the analysts on, considering how much of an impact it really is going to take on these companies' earnings moving forward. We did see some notes about analysts estimating that the price drop could be somewhere in the 40% range from the current pricing. So definitely something to keep an eye on as the negotiation process begins next year.
And Ange, what happens to all of the lawsuits against Medicare now?
Yeah, good question. So, most of these companies that we saw listed, like I said, expected. So the companies had already filed, citing their anticipation as being targeted by this list. Astellas, for example, did not make the cut. Whether or not they will continue to push forward in their lawsuit remains to be seen. Pfizer has not yet independently filed a lawsuit. However, it is, as we mentioned earlier, one of the companies that has a drug listed. Novartis as well is one of those. Novo Nordisk. So a couple of those companies haven't yet individually filed. They do belong to Pharma, the lobbying firm, as well as the U.S. Chamber of Commerce, which we know has filed those lawsuits. But as of right now, unclear on which ones will go forward, which new ones will be expected. And so we're keeping an eye on that for you.
All right, Anjali Kamlani, thanks for tracking all of this and keeping an eye on it. We appreciate it. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. When you think about, you just mentioned water, and that naturally brought back to mind a lot of water that's going to get kind of poured on the U.S. at this point in time. Hurricane season is what we are barreling towards right now. When you think about what this hurricane season could mean for the stock market and compare that to what we've seen in the past, how might this one compare at all, if even?
At the core of it is insurance, right? Insurance and reinsurance that underwrites all of that insurance. And you think about states like Florida, states like California, where it's harder and harder to get insurance, that's going to be a big issue. So the costs are going to rise for these damages, but also, are they going to be able to be insured going forward? That's a big question for investors. That's a big question for banks and anybody who underwrites big projects like this.
Apple shares are on the move today, up by about 1.2% as the tech giant announced the date for its next major product event, officially scheduled for September 12th. It's expected to unveil the iPhone 15 and Apple Watch Series 9. Let's get the details with Yahoo Finance's Dan Halley. Hey, Dan.
That's right, Brad. We're going to be there. Well, I'll be there live in Cupertino on September 12th. It'll be live streamed starting at 1 p.m. Eastern, 10 a.m. Pacific. And what we're expecting is, as you said, the new iPhones, the iPhone 15 line and the Apple Watch Series 9 line. Now, the iPhone 15 and iPhone 15 Pro will be a little bit different this time around. The iPhone 15, that's the base version, and the iPhone 15 Plus, that's the larger base version, are going to get the dynamic island, that little circular pill-shaped cutout that we see on the iPhone 14 Pro line. They're also going to get updated chips. They're going to be the ones from the iPhone 14 Pro, and they'll also get USB-C charging rather than Lightning. Now, that comes after the EU passed legislation calling for universal charging. USB-C does exactly that, and so Apple's going to comply and presumably roll out new iPhones across the world with USB-C. So that should be a lot easier for a lot of people. And it also means maybe having to buy a few more extra cables at this point. For the iPhone 15 Pro, we're looking at the potential for a new titanium casing that would lessen the weight of the device a little bit. Some new colors, gray and blue. And then the big things are that the screen is going to be a little bit larger, the screen space rather, not the physical size of it, but the bezels will shrink, so you'll get more screen real estate. And then camera improvements, obviously, as well as a newer chip than the A16 that's found in the current iPhone 14. Presumably that'll be called the A17. And then onto the Apple Watch. The Series 9 is expected to get a new chip. It's the first upgrade in some time as far as the processor goes for the Apple Watch line. So you should get speedier performance, although I have a Series 8 and I think it's completely fine. And then the Apple Watch Ultra is also supposed to get its second upgrade. We may hear some about the Vision Pro, how that is going to be rolling out, the type of software. And of course, we'll also hear more about the software that'll be rolling out for the iPhone, the iPad, and the iPhone and the Apple Watch. So it'll be a big event. Obviously, this is Apple's most important one of the year. And so you can expect there to be a lot of excitement leading up to it.
And Dan, of course, as we see, more of these phones becoming more high-tech, doing more things, we're seeing some of the prices start looking like, rent and mortgage payments. Do we have any idea of what we're looking at in terms of prices for the new iPhone?
So there's no, confirmation yet. I mean, Apple won't even say that the event is for the iPhone, even though it's for the iPhone. But chances are, with the new titanium frame, reports are that the price for the Pros could increase. And so, that means two things. One, you're going to be paying more out of pocket, which isn't fun. But for Apple, it means the average price per user or average selling price would increase. So that'll likely do better for Apple's margins, considering that the Pro models offer better margins because they're the pricier product. So we'll just have to see. But, with the starting price of $999 for the base Pro, that's going to be
I will have to leave it there. Big thank you, though, to our very own Dan Howley. Well, stay with us. All your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What is your coffee order, or what's the first thing you drink in the morning, if not coffee?
Yeah, it's black coffee, little shot of agave, snaps me right into shape.
Shot of agave, I haven't heard that.
Little teeny shot of agave, just a little kiss of it, and then I get going with the AG1 with the greens.
All right, black coffee, Hershey's Kiss of agave. I like it. Thank you so much. The FAA says it's investigating almost 5,000 pilots for potentially hiding mental health disorders and other serious conditions that could make them unfit to fly. The pilots are military veterans, failed to report that they were collecting benefits for disabilities that could bar them from the cockpit, which is required by law. Here to tell us more about this, Mike Boyd from the Boyd Group International. Mike, good to always get your perspective and some of your analysis on this. So what do we know thus far about how deep the investigation from the FAA has gone and what it's discovered?
Well, I think for us mere mortals out here in TV land, the real issue is how many commercial airline pilots are there? Because of that 5,000 people are flying, either dentists flying on weekends and things like that. But when you say there's 600 commercial airline pilots involved in the investigation, and 60 lost their licenses. That's not all airline pilots. It's not huge, but when you have over 100,000 population of pilots, you're going to find some things like this. But I wouldn't be concerned really with the number that are out there.
And Mike, when you think about the idea that perhaps some pilots don't feel comfortable coming forward because it means they'll be barred from the cockpit, talk about some of what goes into some of the decision making behind this and perhaps some of the support that you think would benefit some of these pilots.
Well, yeah, some of them really don't have a lot of faith or trust in the FAA, and that's understandable. But keep in mind, too, the majority of U.S. airline pilots have labor unions, ALPA, APA, SWAPA. And these are more safety organizations, every bit as much as they are labor organizations. So that's probably the refuge they should take, because they have professionals who can work with that. Let's keep in mind this is a very, very small percentage of people in that pilot population.
How does this change, if at all, the existing kind of the training, the work through that for a lot of commercial airlines, and you were mentioning kind of that part of this larger figure, how they evaluate and make sure that pilots are fit for even going through training in order to get onto some of the flight schedules?
Well, now we have systems. If a pilot is fired at one airline, there's basically a database that will tell another airline what happened there, supposedly. So we have that safeguard in place, and that was from some accidents that happened back in the 90s. So it's getting better, but we're dealing with humans, and humans do crazy things. The Chinese captain that actually co-pilot at that point who flew an airplane straight into the ground in China, there were no indications he had any problems other than being demoted. We don't know. We're all human and these things can happen, but it's not something the consumer should be really worried about.
And Mike, obviously this is something that people would have to self-report. But as you mentioned there, if you're saying that this isn't perhaps a broader problem, but in terms of sort of the checks and balances that are out there for pilots, especially since there was a pilot shortage, you had COVID a lot of times when you weren't seeing a lot of pilots getting trained. How much pressure are pilots under on a day-to-day basis?
Well, they're under probably as much pressure as before. The problem is they may be doing some more flying, but keep in mind there are limits to what they can fly. Now, there's always been arguments between airline crew schedulers and pilots. That goes back to ancient times, I think. But the reality of this is that there are limits to what they can fly, and airlines and particularly pilots unions are working very hard to make sure pilots aren't flying out there tired and hungry, if you will.
How can airline operators do better at even baking in counseling services, baking in things that pilots are afraid to self-report in order to make sure that everyone's in the right headspace as they're going about the operation?
I think airlines have that, but again, they don't get credit for it, but airline pilots unions have systems like this also for their members, because like I say, airline pilots unions are as much safety organizations as they are labor organizations. So pilots do have options there, and you're going to find some people who will lie in every population, every type of category of work. There will be a few pilots that'll be lying to get around the system, no question about it, but it's no different than bankers or people who work out in the field.
And Mike, I want to ask you about the travel season. Obviously, we saw a bit of a crunch during the Christmas holiday period. We thought some of those kinks would be worked out by the time we got to spring break and Easter as well. That also had a bit of a crunch, some delays there. What are your expectations for this year as we sort of wrap up the summer period and come into the holiday period this year?
Well, let's get the Christmas thing mainly was a major computer failure. I mean, a nuclear failure on the part of Southwest. They've fixed that now. But keep in mind, holiday seasons are not like I-95. You get more cars on I-95. You don't get more planes in the sky, and you don't get many more people on the airplanes because they're full even before the holiday. The real issue here is having the ability to deal with off-schedule operations. That gets back to our friends at the FAA and an air traffic control system that is massively understaffed and undermanaged.
And then also, while we have you here, Mike, as we think about, the Labor Day and the holiday season travel as well, there's more of an effort now to make sure that there is kind of an easier just way, given the volume of travelers and people spending on services rather than goods, an easier mechanism for flyers to just have that holistic experience. Is it becoming more evident now that airlines have a better standard operating procedure for the influx in volume that feels like, based on what CEOs have told us, is going to be the reality or the new normal for a time being?
Yeah, airlines are trying to work on that. There's no question. There's some airlines where you have the baggage Nazis at the gate making life miserable for the customer, but that's not the norm. A happy passenger is a inexpensive passenger to handle. Handling, I used to do this at an airline. To handle a complaint letter is obscenely expensive. So there's an incentive there. And airlines have worked very hard to have as many systems in place to handle things before the problem happens. The problem with that is when the system goes down, boy, every man for himself.
Mike Boyd, Boyd Group International President. Mike, we appreciate the time and insights as always.
Thank you, sir.
Thank you. All right, well, with over 100,000 migrants from south of the border seeking asylum within the U.S., local and state officials are getting antsy and looking for answers. In New York City, Mayor Eric Adams and Governor Hochul are arguing as the city claims it cannot hold all of these new arrivals alone. Here with the latest, we've got Yahoo Finance senior correspondent Rick Newman. And Rick, what are we hearing from some of the elected officials on this front?
Everybody's blaming everybody else is what's going on. Welcome to the immigration problem in the United States. This is a nice microcosm of why our immigration is so completely broken. So you've got 100,000 migrants in New York City, as you say. Eric Adams, the mayor, wants some of them to go elsewhere in New York. There are a lot of communities in New York outside of New York City that say, no, we don't want them. The governor of New York wants the Biden administration to speed up work permits so that you can actually get these people employed, earning some money, and having some cash to be able to pay for themselves. But the Biden administration says, well, we don't have the funding to do that. Congress needs to pass bipartisan immigration reform. Congress is never going to pass bipartisan immigration reform. So we've got a complete mess that nobody can solve.
And Rick, I mean, with that in mind, you also have, other states busing or flying migrants into some of these cities as well. How much of a political football do you think that's going to be as we head into an election year?
It's totally a political football. I mean, which is one of the reasons we don't fix this. I mean, Republicans in particular block a lot of efforts to address this problem because they don't want to sign off on anything that would basically allow a lot of migrants who got into the country illegally to stay here. They are sticking with this hardline view. But the reality is you've got something like 11 million or 12 million migrants in the United States who came here illegally, spread throughout the country. The judicial system for processing their claims takes years. I mean, and many of these people are functional and productive contributors to the U.S. economy. By the way, we have labor shortages in a lot of places. The national unemployment rate is around 3.5%. In New York State, it's 3.9%. You can barely get people to work on farms and take a lot of other jobs. So in a better system, you would say, let's try to turn this whole situation to our advantage. These people are coming here mainly to work and live a productive life. So let's help them do that. And meanwhile, get them working, get them earning money, get them paying taxes, get them contributing to local economies, which is one of the reasons you saw a bunch of business leaders just this week in New York City send an open letter to Congress saying, could you guys please do something about this? It's not going to happen, which is why it's so frustrating. I will say one thing. There is a chance here for the Biden administration to try to find some creative fixes to show that Biden is actually doing something to address the immigration problem. So far, the DHS under Biden has just said there's not much more we can do without help from Congress. But they should be sounding the alerts at the White House and telling President Biden, look, you're underwater in the polling on immigration. It's one of the worst issues for you in terms of public approval. So maybe use this as an opportunity to show that you're able to do something.
It's certainly tough when you see the solutions there, but no one really wants to touch anything because, you know, going into a presidential election year. Appreciate your insights, as always, our very own Rick Newman.
Hey, guys.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Have you tried pickleball yet?
I have not tried pickleball. I can't move left to right. My knees are shot from too many years of playing soccer and skateboarding. So I can't do pickle, but I can play plenty of golf.
Plenty of golf. All right, well, I'll meet you out there then. We'll have a great deal of time there. CNN officially has a new face at the helm. Mark Thompson has been named the new chairman and the CEO of the media brand. Thompson formerly served as the president and CEO of the New York Times and director general of the BBC. And this comes amid a big time for the strategy that we've seen play out within Warner Brothers Discovery on the streaming front. It'd be interesting to see, Rochelle, what type of play or positioning Mark Thompson sets forth in this new position too.
It's true. I mean, we saw that what we're looking at his background, that he transformed the Times newspaper into a digital-first organization with paid subscribers, a very different tack than what we saw with Chris Licht. One of the first things he did was close CNN Plus. So it'll be interesting to see what they do with their digital platform. But obviously, this is someone who comes with decades of experience, you know, especially coming from the BBC. And it's interesting. I mean, we saw that Warner Brothers Discovery CEO David Zaslav saying, "I am confident he's exactly the leader we need to take the helm of CNN at this pivotal time." So it'll be interesting to see where CNN goes from here.
Yeah, it's been quite the changing of the guards and trying to figure out exactly who the leader should be at CNN. I mean, a lot of people remember there's essentially been 4 people who have led this company over that past few months. And so finally, a little bit of clarity perhaps moving forward from here. Well, Rochelle and I have you for the next hour. Stay tuned. You're watching Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufa alongside Brad Smith. Here's what we're watching this morning. Bitcoin off today as after a big win with the SEC, what this means for the future of crypto coming up this hour. And why reinstating student loan payments could spell bad news for the housing market. We'll break that down for you. Plus, safety regulators are doubling down on Tesla's Elon mode, what this signals about the future of self-driving technology coming up this hour. But first, let's take a look at how the major indices are doing. As we can see, it's been a bit of a roller coaster this morning as we got that positive information from that revised GDP data showing that the Fed might not have as much work to do, so that did enthuse investors, but now we're seeing some of those gains paring back still. The Dow up about 35 points or 1/10%. The S&P 500, they're also up about 1/3%. Energy leading the way, utilities under pressure. Tech-heavy Nasdaq, they're also up about 0.5% or about 60 points on the day. Let's also check in on the Treasury market action as well. As we see from the short-term yields there, we're seeing that's down about 0.6%. Also seeing the 10-year pulling back by about 1/3%, still above that key 4% mark though. And the long-term 30-year yield, that's also off, but ever so slightly.
Well, the revised estimate for U.S. GDP came in at an annual rate of 2.1% in the second quarter. That's down from the first estimate of 2.4% as a drop in exports offset the tick higher in consumer spending. This slower growth news came as ADP reported fewer private payrolls added in August compared to July. That was down to 177,000. And the news seemed to send stocks higher momentarily as investors hope a slowing economy could mean an end to monetary policy tightening from the Fed. Joining us now, we've got Keith Bliss, BlocksCross Global Head of Markets and Strategy. Keith, great to have you here in studio with us.
Thanks, Brad. Good to be with you.
First and foremost, you look at some of the economic data readings that we've got over the course of this week. We still have PCE that we're yet to get. We still have yet to get the, of course, monthly jobs report as well. But what is this starting to spell out about what the Fed is most likely going to do, as all signs point towards nothing at September, but perhaps November in focus?
Yeah, I think we're going to have to wait and see some of these other data points as they continue to roll along. Certainly the data that we've seen is rolling over from the robust growth that we saw in the first and second quarter. I don't think it spells doom for the economy. I don't think it actually changes the calculus of the Fed. Very little, if at all. So certainly the price information is going to be the most important point that they're going to look at. The Fed focuses on the core PCE. That's what they're going to look at. Inflation is still, even though it's come down, is still higher than they want. So again, September is probably off the table for a rate increase, but later in the year we could see more price increases, particularly when you take a look at what the third quarter GDP estimate is out of the Atlanta Fed. They're tracking at a 5% rate at this point in time. So if you have 5%, you have interest rates. If you have 5% or even higher, that will be higher than interest rates. You still have a lot of capital sloshing around the system. That means inflation will heat up again and the Fed will be forced to move. So for right now, I think they stand pat, let the data play out a little bit, let the markets trade, get back into the busy season of September and October, and then reevaluate where they sit.
And Keith, Rochelle here. I mean, we saw that brief sort of spark with markets this morning as they saw that revised GDP data. But as is usually the case, some sobering tends to then kick into the markets as well. How should they be viewing this period? Obviously, we have a lot of data that's going to be coming out. What sort of investment mindset should people have at the moment?
Well, quite frankly, this is a bit of a punt here, but I think people should probably stand pat for the rest of the week. Think of the things that we have coming at us. At the beginning of August, the markets got broadly oversold, and they're just now fighting back. Yesterday was, I would say, an anomaly to the trend that we've seen throughout the month. And also bear in mind, Rochelle, that this is the slowest month of the year. People are just finishing up their vacations. They'll come back after the Labor Day holiday and get back to work and start reevaluating their positions. Portfolio managers, both in the mutual fund complexes, the large banks, as well as the hedge funds, will really start looking at their portfolios, start doing some tax harvesting, as well as understanding where they can book the gains so they can show outsized performance relative to their benchmarks. But for right now, this week, I would just stand pat. The markets are terribly neutral, fighting back. to the neutral point with the S&P, the Index, and the Russell 2000. So I would trade around the margins. There could be some good values out there. I'm not sure I would be entering into a large position in a company like NVIDIA, for example, who is bumping up against their all-time high, maybe rightly so. But just managing the positions, keeping cash, keeping your powder dry. There probably will be some opportunity when we get into the really volatile September season.
Yeah, being cautious of some of those Goldilocks scenarios right now in the markets. But if there is a trade, then investors could perhaps kick the tires on going into Q4, going into an environment where a lot of retailers even have looked at back to school shopping and said, all right, this is giving us a little bit of inclination to believe that we're going to see a strong holiday shopping period. Is there anything that investors could be keeping an eye on or a top trade going into Q4?
Well, I think you raised a good point there, Brad. I think any of the consumer stocks going into the third quarter prints that we're going to see in GDP probably will get a good bounce. And if you make the bet that the Fed will stand pat, then those will be good places to put money. My own personal bias on a lot of the trades is on the short side right now. For example, bonds are starting to get overbought. We've seen that move yesterday from the JOLTS data and what we'll probably see here. So there'll be, in any of the bond ETFs, there'll be a good short position you could do there. And if you look out over the horizon, 3-6 months, you could probably put on a good short position in anything around the housing market right now. Housing will get weaker, especially if interest rates get up higher than they are. Talk about what's going to be the impact of students having to repay their loans. There's going to be less money in the system. Savings have come down pretty substantially since just after COVID ended. So there's not going to be a lot of money to be put into the housing market, especially as things stay a little bit more expensive and rates are still high.
And Keith, we are still seeing a lot of people being defensive right now until they get a bit more certainty. But then, of course, you also had Grayscale's win over there with the SEC, perhaps lifting some appetite for some riskier assets. What's your take on sort of moving into some of these riskier assets? Well, it's still very early days for what happens next with Grayscale's spot Bitcoin ETF.
Yeah, it is. I mean, it's an interesting situation. I think broadly speaking, Rochelle, when you look at the digital assets and crypto market, which is what we play in at BlackCross, mostly in Latin America right now, is that we're still very early days. What I think is instructive about some of the recent developments and judgments that we've seen, especially yesterday with Grayscale, is that cryptocurrencies, digital assets are here to stay. The recent kind of right sizing of the market that we've seen since 2018 and the recent crypto winter and the failure of FTX, those are very positive for the marketplaces. And so there's going to be excellent opportunities both in the private markets and eventually in the public markets to invest in digital assets companies. I would not necessarily suggest that people should be throwing a lot of capital into the very risky and speculative tokens, a lot of them that you see out there. But try to look at things like a Bitcoin and Ethereum, some of the other tokens that actually underpin real business models and developments that are going to happen on the blockchain and in other areas. Those would be the appropriate places to put. And some people would deem those as risky bets, and maybe they are a little bit more volatile than buying a basket of 50 stocks in the Fortune 50. But those would be good opportunities to take some of your discretionary cash, put them into those situations, and watch them appreciate. Because I obviously I'm a big believer that blockchain technologies, cryptocurrencies, digital assets, and all the innovation that comes along with that will accelerate dramatically in the next 3 to 5 years.
And we'll certainly be watching all of that. And of course, everyone, do your homework before you decide, which of these crypto assets to invest in. I do appreciate you joining us this morning. Keith Bliss, BlackCross Global Head of Markets and Strategy. Thank you for your time this morning.
My pleasure.
Well, following yesterday's ruling on Grayscale, the future of Bitcoin might look a little different. To tell us more about the impact on Bitcoin and what the future might look like, Yahoo Finance reporter David Hollerith joins us now. Hey, David.
Hey, Rochelle. I think the ultimate hope, at least from a market structure perspective, about the spot Bitcoin ETFs is that the future for Bitcoin, it might look a little bit less uncertain, if that makes sense. Obviously, the volatility is something that a lot of people love. But, I think if we point to the movement around the Grayscale's decision yesterday, and then also the drop we saw a few weeks ago, a thing that's undeniable right now is that liquidity is extremely thin in the crypto market, especially for Bitcoin. And something like a spot Bitcoin ETF being issued would bring a lot more capital into the market. And that obviously will attract more institutional investors, and it opens access to retail investors. So there's a lot to be figured out before that happens. But, that's the big thing about the Grayscale decision that's come out. And obviously, as the Grayscale CEO sort of brought up to you guys earlier on the show today, it kind of changes the environment right now for cryptocurrencies. It's been a pretty rough year so far from regulatory perspective. And this is sort of like a victory in the opposite direction, which I think a lot of the industry is sort of celebrating right now.
Yeah, David, as Michael Sonnenschein also brought up to us, there's a 45-day kind of period where there can ultimately be this additional appeal from the SEC. Is there any merit? Is there any kind of risk that the SEC could present its case and this could turn in a different direction?
Yeah, I mean, obviously, in different cases, like Terra and Terraform Labs and XRP, we sort of saw this where the SEC came back and appealed. There's been a little bit of doubt cast in the last day about whether or not that would happen. And the main problem is that the SEC's already issued a futures Bitcoin ETF. And that's been the main argument here. So they will need to come out with an entirely new argument for why there's some reason why they can't approve a spot Bitcoin ETF. That being said, though, it is fair to point out that oral arguments for Grayscale sort of happened in March of this year. And back then, it was even kind of clear that judges were showing sort of more favoritism towards the Grayscale side. So we have to assume that the SEC is aware of this and has planned something. That being said, the last we have heard from them is that, they're currently reviewing the verdict. But anyway, if they do not appeal the decision after 45 days, which is sort of the second week of October, we'll get kind of what looks like a final mandate from the court. And in this scenario, that'll give us more of like directions about how Grayscale could potentially operationalize next steps in terms of whether or not they would refile for a spot Bitcoin ETF conversion, or we would see something else. I mean, there are 10 other Bitcoin spot issuers who have applied to the SEC. So it's a little bit of a horse race right now. And the order is not exactly clear in terms of filing.
All right, David Hollerith, Yahoo Finance Zone, helping us cover this. And of course, our viewers can go check out the full interview with Grayscale CEO Michael Sonnenschein on the Yahoo Finance platform. Thanks so much, David. All right, guys, we're also watching Zillow and Redfin stocks this morning, both higher as housing data shows the real estate market remains resilient despite rising rates. July pending home sales increased at the fastest pace since January. That's up 0.9% month over month, according to the National Association of Realtors Index. Sales, however, they did fall 14% compared to last year, but at a slower rate than the month prior. Shares of these online real estate companies' sites have soared so far this year to date. Zillow is up over 60%. Redfin is up over 120% as low existing home inventory keeps prices high and home builders busy. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. How would you describe the state of the consumer right now?
Well, I think the consumer is actually doing pretty well. I mean, look at the retail sales numbers that we had yesterday, and I think that's part of the good news is bad news story, that if the consumer is doing pretty well, we actually have some concern that we need to keep fighting inflation more.
The pause on student loan payments for borrowers over the past 4 years or so is coming to an end. The impact that it could have on the economy is weighing on investors' minds, and a new survey from Pulsenomics is finding that it may have a negative impact on the already troubled housing market. Let's bring in Yahoo Finance's Danny Romero to give us the details here. Danny, what do we know so far? This is something that just came up in our conversation with Keith Bliss as well.
Brad, more than 100 housing experts are flashing their high beam lights given this survey from Pulsenomics. The biggest takeaway from this survey shows that more than 75% of respondents say that the return of the student loan repayments will have a negative effect on household formation and home ownership rates lasting more than a year, while 40% say that the impacts could last for at least 3 years. The reason, well, 70% of student loan borrowers, which amounts to about 30 million people, are between the age of 25 and 49 years old. So this is known as the prime time for when Americans settle down into a home, get married, start having kids, and that source of demand will likely be under pressure as household budgets could be strained by student loan payments after almost a 4-year pause. Another point to highlight is that homeownership is just one of the few ways that lower income households can accumulate wealth. So that reduction could really have some long-term effects. The National Association of Realtors found that over a 30-year period, a homeowner who purchased a single-family home would likely accumulate over $350,000 in home equity in the U.S. About 75% of that came from price gains, which we're seeing in the market right now.
Okay, so who wins in today's housing market then?
Cash buyers have the upper hand in today's market. They can bypass a lot of the higher rates that are going on right now. And also about 1 in 3 homes is bought in cash. And then, pending home sales just came out today, and we saw that it slightly had an uptick there in July. So that's the second month of a consecutive gain. But so is this an indicator that the housing market is on a rebound? That's a really tough argument, especially since there are several factors weighing the market right now. High mortgage rates, low inventory, high home prices. So the affordability is still under pressure right now. But the latest data does show that buyers are still in the market, whether it's the new home market or the existing home market. Brad.
It's interesting to see those all cash buyers certainly still cashing in. Big thank you there, our very own Danny Romero. Well, there's been a lot going on in the markets, from earnings to Federal Reserve Chair Jerome Powell's speech at Jackson Hole last week, which have kept investors questioning risks in the U.S. economy. And so how can you best take advantage? Well, our next guest says that investors should be focusing on fixed income ETFs and specifically investment-grade corporate bonds. As part of the ETF report brought to you by Invesco QQQ, let's bring in Franklin Income Investors Senior Vice President and Portfolio Manager Todd Brighton to discuss this more. Good to see you, Todd. So start with some of your top picks here then in this environment.
Morning, Michelle. Thank you for having me. So Income is an INCM is an actively managed multi-asset ETF. We employ a flexible asset allocation policy that allows us to deploy capital in areas of the market that offer the most attractive prospects for current income as well as capital appreciation. So as you talked about, we do have a preference for fixed income today, specifically higher grade, investment grade corporate bonds. So as we look across the landscape, we think about the different risks, the places we can allocate to. We really think about it as 3 broad buckets, and those being interest rate or duration, equity market risk, and then credit. And as we sit today, we've obviously have a rate dynamic that looks significantly different than it did 12 to 18 months ago. And we have yields in the investment grade space approaching 6%. Those are yields we haven't seen in upwards of 10 years. If we rewind the clock, to the middle of the pandemic, we had the 10-year U.S. government bond yielding 50 basis points. We had cash yields at 0. So really the backdrop within interest rates has changed tremendously, which has really changed our calculus as we think about multi-asset investing, think about looking at equities, investment grade, high yield bonds. So that's really led us to what we see as a really tremendous opportunity within investment grade. And that's very different from where our multi-asset portfolios sat 2 years ago, where we had much more equity market risk, much more equity investments within our portfolios.
Hey, Todd, Brad here. I want to talk more about this idea of selectivity within equities and what that actually looks like in practice.
Yeah, so clearly we think there are opportunities within equities. It's been a very interesting, a very narrow market this year. I'm sure, as everybody is well aware, that seven horsemen really driving the market forward. And we think what that has done is, a lot of sectors, a lot of industries, have been left behind. They might be, have strong secular trends, but are facing, more short-term cyclical dynamics. I would point to something like the analog semiconductor industry. Obviously, there's pockets of the semi industry, like NVIDIA, that everybody's quite aware of, that have done extremely well. But there's other pockets that have struggled as we've kind of dealt with the inventory issue in the channels. They are starting to work through that. But as we look longer term and we look at the analog semiconductor content that's in a electric vehicle, that's in an autonomous vehicle, that's in what's required for factory automation, what's going on within data center, these are tremendously strong long-term secular drivers for this industry. So that's an area that we find particularly attractive today, as I mentioned, possibly facing some short-term cyclical issues, but over the long term, we think they'll do extremely well.
You mentioned the seven horsemen. I mean, we've heard so many different takes on the sevens. There's the Magnificent Seven, there's the seven horsemen. I mean, you could go Serendipitous Seven, whatever. At the end of the day, has there been a clear ETF play that's emerged as a result of the successes of the sevens?
Yeah, I mean, probably not the best place to answer that. I think, as I discussed, we focus really around multi-asset income investing, and that's how we think about investing. We do think, there are plenty of areas within the market. I mentioned investment grade corporate debt, but also non-investment grade, and within equities where you can find not only current income, but as well as those prospects for capital appreciation. So we think INCM is a particularly attractive vehicle for investors looking for income as well as growth.
And Todd, what would signal a turning point in the sort of ETFs that you're focused on right now? Obviously, you have an interest rate environment that's a little bit uncertain, fears of a recession coming up, potentially if the Fed can't stick that soft landing next year. What were some of the signals that you'll be watching for when it's time to rotate in or out of some of these ETFs?
Yeah, I think, for our positioning today, what we've seen over the last couple of days has been, so we're in that interesting time period where, challenging or slightly softer economic data is better. We think that's good for our positioning. Obviously, rates have gone lower a little bit over the last couple of days. The equity market has liked what they've seen. But I think as we move forward in this, if we continue to see continued soft economic data, that will start to be a little more negative for equities and potentially positive for fixed income and bonds. So we're watching. We do think we're in a very challenging time period today. We've heard from Chair Powell many times over the last couple of weeks, just most recently at Jackson Hole, that the Fed is very data dependent. They are willing to move and have another interest rate increase if necessary, but they're also, could be at the end as well. So I think what we've seen over the last couple of days, the economic data has been helpful for us being at the end of the interest rate hiking cycle. But, we will be, very cognizant of the data that comes out over the next couple of months. The Fed's obviously watching it very closely. And I think for us, regardless of whether there is one more increase or whether we are done. At this point, we are much nearer to the end. We are digesting over 500 basis points of interest rate increases in the economy today. And now we're talking about maybe there's one more, 25 basis points more. But otherwise, we're near the end, and now we're just talking about the length of how long the Fed will hold interest rates at that level.
Franklin Income Investors Senior Vice President and Portfolio Manager Todd Brighton. Todd, thanks for taking the time here with us today.
Thank you, Brad. Absolutely.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise. Fresh water, water for industrial projects, water for municipalities, that's going to be a big issue. It's not going to be a big issue this year, potentially, but going forward, I think that's one thing investors need to be paying attention to.
Some stocks in China taking a breather today after investors bought the dip over the last several sessions. Talk of more government intervention to help China's struggling property market is raising investor sentiment. Inez Ferre has the details here. Hey, Inez.
Hey, Brad. Yeah, and we are seeing a little bit of pressure on some of these stocks today, a little bit of a breather, as you just put it, especially when it comes to the EV space. Part of that has to do, of course, with NIO's latest results. So you can see on our Wi-Fi Interactive that you're looking at the EV stocks that are under pressure. But the rest, a little bit of a breather, mixed picture. I'm going to pull up a 3-day chart here so you can see some of the dip buying that went on over the last couple of sessions. And if I pull up a 1-month chart, you can see the action there there. I'm going to pull up BABA because in a 1-month chart, you can see here a low here around August 21st, and then the dip buying that went on after that. A 1-month chart here shows that it's down 7%. But look, the government has been taking measures, the Chinese government, a couple of measures to lift the market, the stock market, cutting a stamp duty on stock trading for the first time since 2008. Also, Chinese officials asked large funds to avoid selling more onshore equities than they purchase. And an important measure that investors are awaiting is that banks are expected to cut interest rates on existing mortgages. And we know that the property values in China have been plummeting. A lot of wealth is tied to property values. So likely this is going to have a modest boost, what analysts are saying, perhaps not as much as what investors would want. The stock market still is a barometer, for a psychological barometer for many. Their wealth is tied to property values. And also, of course, if they see the stock market going down, that's not good for investor sentiment.
And then, as you mentioned, property values there, and one of China's biggest developers just posted results for the first half of the year. What did those tell us?
Yes, and this is significant. This is Country Garden, which posted a loss, a record loss in the first half of the year, more than $6 billion compared to a profit last year. Also, the company saying that it is facing a liquidity pressure, and it missed interest payments on its bonds earlier this month. And earlier today, this developer saying that it will pay down a loan by issuing shares. Now, this is very significant because it is one of the country's biggest developers when it comes to property. And this is a worse credit crunch than what Evergrande saw. We remember Evergrande from last year because it has 4 times as many property projects than Evergrande. So this also underscores the free fall that property is going through in China right now.
Indeed. Appreciate that update, Ines, for it there for us. Thanks so much.
Thanks.
Well, Eminem is demanding GOP presidential candidate Vivek Ramaswamy to stop playing his music. A cease and desist order was sent to Ramaswamy's lawyer more than a week after the candidate rapped the hit song Lose Yourself at a campaign stop in Iowa. To tell us more, Yahoo Finance's Rick Newman is here. So, Rick, what is really going on here? Oh, look at the hoodie.
You like my song, but I don't like you. Up there on the stage in your fancy suit, you got $1 billion and that shiny tooth, but you're kind of a dick, so make your own song, fool. I think that's what Eminem's trying to say.
Okay.
I'm speechless.
I'm speechless. Rick,
Rick,
you got us so speechless here. You came on looking like dark mode Kermit for a hot second there, dropping some Eminem rhymes for us real quick. All right, so this is not the first time that we've heard musicians taking issues, especially with GOP candidates, using their songs before. Trump had a history of this, and so now Ramaswamy.
Well, the recurring theme is Republicans co-opting popular songs that talk about street life and tough life. And there's cognitive dissonance here, of course, because, Ramaswamy, to use one example, I mean, he's a hardcore conservative. He wants to cut social programs and basically slash the government. He hates welfare. And what does Eminem sing about? I mean, he sings about life on the streets and, trying to get ahead from a tough start. We've seen this before. Chris Christie, when he was running for governor, I think, in New Jersey, he played a bunch of Bruce Springsteen songs, and Bruce Springsteen said, "Knock it off, man. I don't really care for your politics." The Rolling Stones asked Donald Trump to stop using one of their songs. I mean, one of the most famous pieces of music in a presidential campaign was the old Fleetwood Mac song, "Don't Stop Thinking About Tomorrow," which was Bill Clinton's theme. And I don't think Fleetwood Mac had any problem with that. So the safe route here for Republicans is just stick with faux patriotic country songs. Stop trying to get into rap and rock and roll because they don't want to be associated with you, Republicans.
So then, Rick, what is the difference then between actually playing the songs versus rapping the songs? Is there any sort of difference there that would give Vivek perhaps a little bit of wiggle room here?
So that's a legal question, but there was apparently some kind of arrangement before anybody really know who Vivek Ramaswamy was between him and Eminem, where Vivek was allowed to use Eminem's music to some extent. But then came the GOP debate from a couple of weeks ago, or last week, I guess it was. Time flies. And Ramaswamy really stood out as a super hardcore, extreme conservative. So among conservative Republicans, some of them liked him, but other people really didn't like him. And my view of Ramaswamy is he's completely unelectable in a general election. There's just no chance he could beat a Democrat, including Joe Biden, because he's extreme. I mean, so I think what happened is Eminem and a lot of other people were kind of like, oh, this is who this guy really is. I don't want to be associated with him anyway. So like I said in my rap at the beginning, Vivek Ramaswamy, you need to make your own songs.
All right, Rick, appreciate it here and giving us the full breakdown as well as some historical context as well. There you go. We've got your new LinkedIn profile and resume updated here. Part-time rapper. Let us know when that new album drops too.
Yeah, I'm working on it. Maybe I'll go viral and that'll do it.
Bars. All right, Rick Newman, thanks so much. Appreciate it.
Bye, guys.
Everyone, we've got much more markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Everybody's been keeping an eye on China, and there's been some very not so good, not so fun type of economic data that's come out of there. There's been lackluster economic data from China compared to the expectations coming into this year. Are we witnessing, as some have kind of leaned back to and called it, are we witnessing the makings of a lost decade for China?
Well, I think the challenge is, really this highlights how out of sync different economies are globally right now. You're really seeing the US in a very different situation than Japan, than China. And you could be right. They've really had a lot of tremendous economic growth. And it also highlights that it takes longer to get out of a difficult period than people really expect.
Tesla is facing more scrutiny for its driver assistance system. The EV maker is now fielding calls from the National Highway Transportation Administration to provide extensive data on its autopilot systems known as Elon mode. Let's bring in Yahoo Finance's Pras Subramanian to hear more about this latest order from regulators. Hey, Pras.
Hey, Rochelle. Yeah, Tesla facing more scrutiny here with autopilot. The concern here, did Tesla make it easier for drivers to take their hands off the wheel while the system is engaged? Now, according to NHTSA, the agency became aware of an autopilot configuration that, when enabled, allows drivers using autopilot to operate their vehicles for extended periods without autopilot prompting the driver to apply torque to the steering wheel. This is colloquially known as Elon mode. Something that CNBC first reported on a while back. So NHTSA asked Tesla to respond by August 25th to this allegation. And according to NHTSA's website, Tesla did respond confidentially. Now, for its part, Tesla says autopilot is intended for use with a fully attentive driver. So Elon mode clearly doesn't comply with this if you think about it from that torsional sort of feedback that one must give to the steering wheel to make the car aware that you actually are still holding the wheel.
And so is this likely to move the needle on people who are looking to or are considering buying Tesla vehicles?
In the sense that they not want to buy it if it's underinvested. I'm not quite sure about that. I know that autopilot is a distinguishing factor that people actually talk about. Hey, this is an advanced autonomous driving feature that people would like to use in their cars. And I think right now we're not seeing that effect just quite yet, especially with the fact that they've added the monthly subscription feature where you can pay $150 or whatever it is per month to have it, as opposed to the $15,000 for FSD. So it's a better way to get into it. But I think right now feature's still available for use. Yeah. It's still in the process of the whole NHTSA investigation. I think the bigger issue, Brad, is this whole bigger investigation into Tesla cars on autopilot crashing into emergency response vehicles at scenes. That's sort of a big issue that people are kind of concerned about. And if that means taking autopilot off the market or something like that, then I think you might see a big impact to sales.
Yeah, absolutely. Pras Subramanian, thanks for breaking that down for us here today. We also are monitoring a new survey from Bankrate that's found that bank overdraft fees tumbled to a 13-year low. Banks have been reducing or eliminating overdraft fees after they faced heavy public pressure to curb junk fees, extra fees put on top of unfair prices that are sometimes hard to find merit for. But the survey also found that consumers were seeing more money go into ATM transaction fees, especially for using ATMs out of banks' networks. The average combined ATM fees for an out-of-network withdrawal came to a record high of $4.73, which just beat out the previous record in 2019 of $4.72. Joining us now with more about the survey and how you can think about saving, we've got Bankrate.com Chief Financial Analyst Greg McBride. Greg, great to have you here with us. Help us break down a little bit more of these findings here and where perhaps people might be getting nickel and dimed as they're looking to take out some of those dollars.
Well, the ATM fees, Brad, they remain in the sort of upward trend that's been continuing for decades. And with less use for cash, with people making fewer ATM withdrawals, the cost of maintaining those networks is being spread over fewer transactions. That's really been a big contributor to the steady escalation in fees that we've seen over the years. The other thing to keep in mind is that if you go outside the network and make an ATM withdrawal, you're not just paying one fee. Oftentimes you're paying two. You're going to pay your bank and you're going to pay the ATM owner together. Those fees average out to almost $5, but you could easily pay more than that, as much as $6 in some cases. So really pays to plan ahead as to where and when you make those withdrawals.
And Greg, you raise a good point, because I can't actually remember the last time that I went to an ATM. There's so many different ways to sort of get, cash back when you make a transaction. If they, ask if you want money back that way, you have, some things like Cash App and other ways to basically get cash to people without having to take cash out. What does this mean then for the future, some of these ATM fees? Are we just going to continue to see them just keep rising?
Yeah, I think over time, Rochelle, we will see the fees continue to rise. We may also see fewer ATMs over time as cash becomes less and less popular as a payment mechanism. But for now, it's one of those things where even if you're in a pinch, as you noted, you can get cash back at the point of sale when you use your debit card. You're not hostage to higher ATM fees. I have to tell you, I was in an airport a couple of weeks ago. There was an unbranded ATM in the airport. Those tend to charge the highest fees. And there was just a steady stream of people making withdrawals from this ATM. It's like, what? You didn't realize you needed cash for vacation? So just, planning ahead so that you can do that within network And a lot of smaller community banks and credit unions, even they belong to nationwide ATM alliances. So, it's very feasible. Most people may have thousands or even tens of thousands of ATMs at their disposal that they can use free of charge.
And so I'm glad, Greg, that we've got these tips up on the screen right now. What are some of the best ways that people can avoid higher ATM fees?
Yeah, plan ahead. A lot like health insurance. You got to stay inside the network. If you go outside the network, it's really going to cost you. Pull out your phone, look on the bank's app, and find the location of nearby ATMs. Plan ahead as to where and when you make those withdrawals so that you can do so within the network or at one of the surcharge-free ATMs that's within the bank's alliance. It's really, really important there. If you're in a pinch, as Rochelle noted a moment ago, you can get cash back at the point of sale when you use your debit card. That's a way it's essentially tantamount to a free withdrawal. Great way to get cash if you're really in a pinch and you're not nearby an ATM.
And obviously, for some people who need to make purchases and they don't have an ATM and they start relying on their credit cards, we're seeing this rise in credit card delinquencies as well. Talk about the demographics that we're seeing within that, because we keep hearing that title, that $1 trillion number, but within it and the demographics there, what are you seeing?
Yeah, it's not the $1 trillion that really gets my attention. It's the trajectory, the fact that we've got some of the lowest unemployment in more than 50 years, and yet we are seeing delinquencies move up. We're seeing credit card balances move up. More people are carrying balances. They've been carrying them for a longer period of time, and at a time when credit card rates are at a record high. So, people are not financing purchases at 20% because everything's hunky-dory. They're doing it because they're feeling financial strain. I think that's a clear indicator of it. Younger and lower income households in particular, but even a lot of middle income households have really been stretched by inflation. More households living paycheck to paycheck, and unfortunately, the credit card has really been the buffer, either for unplanned expenses or just at the point where income stops and the expenses keep going.
Is this likely to change how or where people or who people bank with?
There's a lot of inertia when it comes to something like a checking account. So, we found in other surveys that the average account holder keeps their checking account for like 17 years. Wow. And about more than 1 in 4 admit that they're still paying fees every month. And so take some action. That's an easy way to really kind of plug a hole in your finances. We found free checking accounts are widely available, but it's not going to come knock on your door. You've got to make that first move to get your money in a place where it's going to be welcomed with open arms. 45% of banks offer a standalone free checking account. On top of that, an additional 42% will waive the fee if you sign up with direct deposit. So it's a pretty low hurdle for most people to clear. I'd say free checking readily attainable for most consumers, but again, you're going to have to make the first move.
And you raise a good point, because a lot of times people don't want to have to sort of, transfer all the bills and things they already have associated with their old checking account into a new one, even if it means they're actually going to benefit in the long run. Now, I know that Bankrate looks at a lot of different data. Talk about some of the key searches that you're seeing people have on your website. What are they looking for at the moment as they try and get a better hold on their finances?
Well, I think from a saver's perspective, this is the best of days. I mean, we're seeing the best yields that we've seen in 15 years on things like savings accounts, certificates of deposit, and better still, inflation as it comes down. That means your purchasing power is growing. You're finally earning a real rate of return that exceeds inflation, but you have to shop around. And of course, a lot of people come to bankrate.com to do just that, to find the top yielding savings accounts, money market deposit accounts, as well as CDs. It's a great environment for savers and income-oriented investors.
And then just lastly, Greg, while we have you, I mean, there has been some move on the regulatory front to try and make sure that Congress can effectively regulate a bit more some of the ancillary fees that banks tack on, or at least provide more transparency. Has there been enough of a move towards transparency, or enough of a dampening down of some fees in areas, or are those fees, even as they get removed from one area of a transaction or of an engagement with a bank, just being flowed into other areas that are kind of just plausible and the consumer not really asking any questions about it?
Historically, the game of fees has been a lot like a whack-a-mole, and it goes away one way, or it just pops up someplace else. So you do have to be on your toes. But I think you make a great point. You alluded to it at the top of the segment, that the regulatory and legislative pressure, as well as public pressure around overdraft fees, has really had a stark impact. I mean, this was a fee that year in, year out was going up, and it was very punitive in nature. And yet in the last 24 months, we have seen a complete reversal some of these fees the non-sufficient funds fee is at the lowest in about 20 years. Overdraft fees have fallen by double-digit percentages just over the last year. A lot of banks moving away from this, or at least lightening the burden of it, giving consumers more of a wiggle room to bring their account balance back to positive before the fee kicks in. That's the type of flexibility and fee structure that was unheard of as recently as a couple of years ago.
That's certainly one of the reasons I ended up switching banks. Those overdraft fees, $30 here adding up, especially in an environment like this. It just makes sense to try and shop for better offers. Do appreciate you joining us this morning. A big thank you to Bankrate.com Chief Financial Analyst Greg McBride. Thank you so much.
Thank you.
Well, some big moves in the world of Bitcoin. A federal appeals court says the SEC must review Grayscale's bid to convert its Bitcoin trust into an ETF. We spoke with Grayscale CEO Michael Sonnenschein about the ruling. Here's some of that conversation.
We were taking a look at the reaction yesterday. What type of inflows did you see just off of the ruling itself?
Well, yesterday we actually did see a pretty big spike in trading volume in GBTC. This is the world's largest Bitcoin investment vehicle. It's been publicly traded since 2015. It's been an SEC reporting company since 2020. It's held by nearly 1 million investors here in the US directly within ETFs, within mutual funds. So there are a lot of eyes and certainly a lot of hands looking very closely at the GBTC victory yesterday.
And Michael, Rochelle here. I mean, a lot of people were wondering, questioning the logic. You already have Bitcoin future ETFs allowed. So a lot of people were wondering why we weren't seeing these spot Bitcoin ETFs. What does this now open up? And what's been some of the reaction that you've been getting from investors?
Well, yesterday was really an overwhelming victory, not just for Grayscale and our investors, but for the investment in crypto communities as a whole. The panel of judges unanimously agreed with us 3-0 that the arguments we put forward in front of the court were such that the SEC acted arbitrarily and capriciously by approving the Bitcoin futures products, but not approving Bitcoin spot products like GBTC's conversion. And we really demonstrated, or rather the SEC didn't have a good explanation as to how to make a distinction between these two product types, given that they both derive their pricing from the same underlying Bitcoin market. And so this is a really, really important milestone on GBTC's path to eventually converting to an ETF.
And so walk us through the timeline from this point. How soon could we see the actual spot ETF come forward?
Well, so today is day one of a 45-day period during which the SEC can actually request a rehearing of the case. Okay. So we have to be a little bit patient. We have to follow the federal rules of appellate procedure here. And ultimately, the court will be issuing a final mandate that'll detail the operational next steps. In the interim, however, though, of course, our legal teams will be proactively working with the SEC to try and make for an expeditious as possible conversion of GBTC to an ETF.
Now, Michael, I do have to ask, if the floodgates do open and this is finally approved, how will you differentiate your product from some of the other ones that have also been applying for spot Bitcoin ETFs?
It's a great question, Rochelle, and there's actually already quite a bit of differentiation. GBTC is just a couple weeks away from celebrating its 10th anniversary. And that's 10 years of, operating within the digital asset ecosystem, custody, audits, accounting, disclosure, creations, investor disclosures, tax treatment. All of these things are really core to running GBTC every single day. And in contrast, a lot of the other products seeking to come to market are merely just ideas. They're just ideas on paper. They're just filings. So in a lot of ways, GBTC has paved the way for a lot of the other issuers to even think about bringing their products to market, making use of GBTC's operations, disclosures, financial reporting, et cetera. And I think when investors do have a choice about which product to invest in, certainly thinking about a crypto native asset manager, a product that has billions of dollars of assets, hundreds of millions of dollars of daily trading volume. These are the types of distinctions that I think investors will be paying attention to, but ultimately we do believe investors should have choice.
So is this ruling enough to really kind of overshadow some of the crypto winter detractors to cryptocurrency, whether that's SBF and FTX and what's taking place there, or whether that's the algorithmic stablecoin debacles of last year and the depegging basically to the dollar? Is this enough for investors and for the sentiment that's moved forward and had to navigate so many of these issues?
Certainly. I think investors are paying attention to the fact that crypto has been one of the best performing assets year to date. They're looking at not only the Grayscale victory, they're looking at the recent Ripple victory in court. They're looking at the pending legislation that's being worked on in Washington, both around stablecoins, as you mentioned, as well as looking more at market structure. And it's encouraging from my seat, having been in crypto now for almost a decade, to actually see crypto becoming a nonpartisan issue, to see both sides of the aisle working on legislation. Their constituents are getting involved in crypto. They're getting involved in the name of investor protection. They realize investors are going to be involved in this asset class no matter what. And so I am very encouraged that we will have some progress around a lot of these in the weeks and months to come.
That was Grayscale CEO Michael Sonnenschein speaking there with us. Well, that does it for now. I'm Rochelle Akufo alongside Brad Smith. We'll be back with you tomorrow morning. We'll see you then.